It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Stock futures here pointing to a lower open 30 minutes ahead of the opening bell on Wall Street. The Dow coming off of 5 straight days of gains, its longest win streak since December. The S&P 500 up 4 days in a row.
Treasury yields also ticking slightly higher as investors track a slew of Fed speak this week for hints about the path of interest rates. We're also tracking oil prices falling this morning on indicators of weak demand. So let's get to it with the 3 things that you need to know, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Madison Mills, and Josh Schaefer have more.
Thank you, Brad. We are tracking a slew of corporate earnings. Lyft, Uber, Shopify, and Twilio, all trending tickers after reporting those quarterly results. And we're going to hear from ARM Holdings, Robinhood, and Airbnb, among others, after the bell.
Tesla shares under pressure ahead of the open here. The Justice Department reportedly looking at whether the company committed securities and wire fraud as part of its autopilot investigation. Reuters reporting that prosecutors are probing if Tesla and CEO Elon Musk misled investors about the company's self-driving capabilities, specifically around whether the cars can drive themselves. Tesla's autopilot and self-driving systems can help with steering, braking, and lane changes, but are not fully autonomous.
And shares of Reddit are soaring after its debut earnings report. The company beating on the top and bottom lines, with daily active users rising 37% year over year to 82.7 million, above analysts' expectations. But so much of the stock movement we're seeing is coming from Reddit's guidance. Reddit seeing adjusted EBITDA in the range of $0 to $15 million versus a loss of $13 million Wall Street had expected.
Stock futures edging lower 30 minutes before the opening bell on Wall Street. But Tesla is under pressure here. Reuters reporting that the DOJ autopilot investigation is examining whether Tesla committed securities and wire fraud in its self-driving claims. So we're tracking shares of TSLA here. Pre-market, they are down by about 3.5%, and it certainly has been one of the larger claims that Tesla has continued to lean into, and how big of a deal full self-driving will have, not just for its company, but for the safety of the roadways. That's been their pitch thus far. However, the claims that they're making to investors, to consumers here, we'll see exactly what the investigation does yield here.
Exactly. When we're seeing this stock under pressure, not a huge surprise, one, given the news, but also given the fact that we have really seen a run up since we did get that latest earnings report. So again, when you see news like this is just another reason for investors to kind of take a step back here and reassess the current valuation of Tesla, given the fact that there are so many macro concerns surrounding this name, in addition to the latest news that we're getting out this morning here on this probe. So you couple that with the fact that we are seeing slowing demand for the EV space. There are certainly lots of questions around the robo-taxi, how realistic that is, and exactly what that timeline looks like there going forward. And then also just the ability here for Tesla to continue to sell cars at the rate that they have been without lowering prices even more. We've certainly seen that pressure margins here over the last couple of quarters. So that, of course, is front of mind here to investors. So again, you get a report like this, news out like this here, from what we're hearing exclusively from Reuters. No surprise that we're seeing shares sell off just a bit, now off nearly about 4% here ahead of the open.
You know, the interesting thing is, according to some surveys, and a AAA survey continues to come to mind to me, because as much as we talk about full self-driving and autopilot full features there, you know, there's still a lot of consumer skepticism that is in the market right now. A AAA survey that they continue to run year over year that's looked across some of the fear or uncertainty right now around full self-driving. 66% have expressed fear of drivers on the road right now in the U.S. have expressed fear. 25% expressing uncertainty regarding fully self-driving vehicles. They cited continued lack of trust trend, and this that really peaked in the prior year. And so as we get kind of more of the updates on this, it's really going to become a core talking point for some of the automobile manufacturers, especially in the electric vehicle landscape, which we already know the demand environment has been waning a bit right now. So what is the next big trick that they can pull out? Well, for many of them, they had been leading into full self-driving, but is there something else that they should be messaging, knowing that the consumer mindset right now is actually still a little bit more skeptical than not of the full full self-driving realm here.
Yeah, we can see this news here this morning also coupled with the fact that we had Rivian miss as well. It's really weighing on the entire EV industry landscape. So it's not only Tesla, it's not only Rivian that are under pressure here this morning. You've also got Nikola off just about 1% here. You have Canoo also trading lower. NIO, XPeng, some of the Chinese automakers there, EV automakers, also trading lower on this news. So again, when you get something like this is a move that not only could potentially affect Tesla shareholders, but you also see the pressure more widely based when you talk about EV adoption and exactly what that could mean for this space down the road.
Absolutely. We're also tracking Reddit here this morning. Reddit is among the top trending tickers on Yahoo Finance, the company posting its first earnings report as a public company. And investors, yeah, they seem to be liking the news here. Josh Schaefer is here with the details. I mean, Josh, I forget the mascot's name already. I know I should remember this.
Snoo.
Snoo, that's right.
I didn't
How
have
can I forget
it, so I'm glad you
Snoo?
did.
Yeah.
All right.
There we go.
Well,
I've
first,
Pulling
just
through
been-
for you guys here this morning.
I've just been tracking the earnings report on Reddit, right? That's what everyone did?
That's true.
So per Reddit, I'll read you the numbers, right? So when you take a look at the numbers for Reddit, it really was, I think, the second quarter revenue guidance here that probably impressed the investors the most. Second quarter revenue guidance coming in a range of 240 million to 255 million. That was above the street's estimates for 228 million. And then we were talking earlier about the adjusted EBITDA guidance for the current quarter coming in a range of $0 to 15 million. That's above what the street had been expecting. The street was actually expecting a loss of 13 million. So perhaps upside in revenue here may be driving some of the potential profitability gains for Reddit. That has been a looming question since this company went public, of course, is A, how are they going to make more money? How are they going to bring in more revenue? And then B, when will that eventually lead to profits? I think overall, reading through some analyst notes this morning, people were just generally impressed with the quarter. I mean, Reddit beat what the street was expecting pretty much up and down this report, even when you look at something like daily active users coming in at 82.7 million. And I think the looming question now for this stock is going to be, what do people think of the valuation after we open the market today? It starts to shoot up. Somewhere in the 10 to 15% range is where it's been this morning. Remember the last time we really saw Reddit take off right after the IPO, a short report came out almost instantly, and people started questioning sort of the valuation and the future plans here. It seems like the most bullish people on Reddit are still talking a lot about the AI strategy overall, and that's kind of the long-term play here.
Yeah, exactly. And you got to ask yourself just how long that's going to take to really materialize, right? And that goes to the question about what that growth is going to look like in the coming quarters, because there certainly is a lot to like within this print. But I think those that still remain on the sidelines, we're going to be talking to one analyst later on in the program who still has an underperformed rating on the stock. And he's just pointing to that future growth and exactly when the dust settles and some of this excitement leaves, what exactly the realistic growth is going to look like for Reddit, but also just evaluating this type of name given the crazy trading action that we have seen and given the fact that it is a meme stock. I would think that that would make the job even tougher here for these analysts when they're trying to figure out really the fundamental story here when it comes to Reddit.
Yeah, I mean, when you think about that, Shauna, and sort of zoom out from like a slightly macro perspective, right? It was a good report, and the stock is up a little over 10% in pre-market trading. That's not crazy, but like that's how this works, right? That's normally what you're supposed to see. If you get a beat and raise for a stock that hasn't done that well going into the report, a 10% move is certainly not unheard of. And that's something that our markets reporter, Jared Blickery, was writing about in the Morning Brief newsletter this morning. We're starting to see some of these meme stocks, like yes, they've been on a run. Look at Carvana shares over the last 2 weeks, right? But should we even be calling Carvana a meme stock anymore? Maybe. But it also had a good earnings report, right? And that's why that stock is moving. And I think that's why Reddit is moving here. So for now, it seems relatively tied to the fundamental story. We'll see how much people want to talk about AI today. And then I think you start to get into a yes, that's a use case for Reddit, potential revenue driver. But what is that revenue driver? I mean, it's just still a massive, massive question for this company.
Yeah, they were talking about, particularly within this earnings release, in a world where content is increasingly AI and influencer generated, Reddit remaining one of the few uniquely human places on the internet. That, according to the press release, of course, here. But ultimately, I think it still comes back to, for where AI plays a role within their strategy, what is the biggest source of spending that we've heard about over the course of this earnings season? It has been where Meta is going to spend further into AI, where Google or Alphabet is going to spend further into AI. And so what that CapEx looks like for Reddit could be one of the next big catalysts that investors have to think about in their spending profile in this near term.
And is Reddit going to be a CapEx taker? right?
Sure.
I think that's an interesting part of the story too, Brad. That was something that Laura Martin over at Needham highlighted in her note today. They put Reddit on their conviction list, and she said she thinks Reddit's data will become table stakes for all generative AI large language models over time.
Yeah.
In essence, if you're gonna get into the Gen AI large language model game, if you're gonna make something like ChatGPT and you wanna have something that can interact, you're gonna want Reddit's data of humans talking to use that, right? And so if they're gonna be a CapEx taker from that sense of everyone that wants to get into AI, a lot of people want to get into AI, so maybe they benefit from that.
It certainly is the case, and you can see it across the board when it comes to some of these, so many of these, well, I guess now positioned AI names. All right, Josh, thanks. Let's talk a little bit more about earnings season because we are almost in the final stretch. We've got just about 80% of companies in the S&P 500 reporting, and we're on pace for a 5% earnings growth rate in the first quarter. Putting that in perspective, that's the biggest gain that we have seen in nearly 2 years, according to the latest numbers out from FactSet. But there still are some key names that are on tap to report, especially in the retail sector, and could potentially signal, or it will at least give us a better sense of the consumer. Joining us now, we want to bring in Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, it's great to see you here. So let's start with earnings season right now, because when you take a look at that growth number I just mentioned, 5% earnings growth, the best that we have seen in nearly 2 years. What does that then tell us just about some of that momentum maybe that we should expect to see or is shaping up to see here in the coming weeks and quarters?
Yeah, thank you for having me. And earnings season has turned out to be better than a lot of people expected. I think according to FactSet's numbers, it maybe was 3.4% expectation coming in. We're at a 5% run rate. And that's really, I think helped support the markets here, provide a bit of a floor here. But now what does it mean for the future going ahead? We have seen a divergence really continue where you have more tech companies, more cyclically oriented companies tied to manufacturing and industrials outperforming retail. When I look at, say, XLY, so consumer discretionary, how that has actually lagged the broader market. And so why is that? If the consumer has been doing the heavy lifting with growth so far, what does this tell us about the future? The market might be sending a signal that the consumer is getting a little winded here. We're seeing the screws begin to tighten, and maybe the baton is going to be passed to manufacturing, industrial, and maybe more export-oriented companies that are really hitching their wagon to the global growth recovery as opposed to just being concentrated with U.S. growth.
Brian, why is it that companies that actually post earnings surprises this earnings period are actually being rewarded less than the 5-year average here?
Yeah, that's really interesting, isn't it? And that's something that we oftentimes track is the surprises. If they beat, is it the headline number that the market is focused on? Is it the bottom line number? And when we do the analysis, it appears as though it's more driven by the guidance that they're giving about what to expect for the balance of the year or even over the longer term. So they can have a positive surprise for earnings, but that's really just telling you what they've done lately as far as for the past quarter. The real key question for markets being forward-looking is what's really coming ahead, what's through that windshield. And that's where you sometimes get positive surprises, but then coupled with a little bit of that negative guidance, and then the stocks get punished or they don't get rewarded as much as what you would otherwise think.
Brian, then what does that then tell us about valuations? Because when you have stronger earnings here, coupled with the pullback that we've seen, it makes these valuations look maybe a bit more attractive at this point. But how sustainable are these current valuations?
Yeah, so we've done some analysis here at Annex on our investment committee as far as there's a lot of people out there who look at, say, price to earnings, or they take the inverse of that, the earnings yield, and they compare it to the 10-year Treasury yield. And they say, hey, you know what? There isn't much of a gap there. The 10-year Treasury yield is really rich as far as high. The earnings yield is really low. Maybe that's a negative sign for the future. But really, if you think back to that growth story, stocks hopefully will be able to grow those earnings, whereas the coupon income you get from a Treasury, that doesn't grow. And so we think it's a fairer comparison to look at the price to earnings relative to real yield. So like on inflation protected securities, you can look at the real yield, and that gap isn't nearly as narrow as what the gap between earnings yield and nominal treasuries are. So we think that it's actually for valuations, as long as you are looking at companies that are quality, profitable, and that have that earnings runway ahead of them as far as that growth, that's where we think the better opportunities are, and the valuations are therefore more sustainable.
When you have Fed members questioning policy tightness right now and not taking off the table a potential cut entirely and for this year potentially, but then also leaving on the table a potential hike here. I mean, that's signaling a little bit more unease that the markets may have to ingest here. What do you think the reality of how the Fed is evaluating this current economic reality and environment could net out in? Do you think we'll see another hike?
Not yet. I think that we actually aren't going to see a hike until we've seen a few cuts. So at some point in the future, they will likely have to hike again, but from what level? And I think it's actually healthy to show that there is that disagreement on the Fed keeping hikes on the table. Chair Powell effectively said there's a very, very high bar in order to hike rates. Other officials have said, no, maybe that bar isn't quite as high. So really what matters is the committee decision, and Chair Powell is really at the center of that committee. So his view is probably the most important, and there's that very high bar to actually hike. We believe that inflation is going to start trending lower. The first 3 months are not a prelude to what to expect for the next 3 months for inflation. Now, of course, I could be proved wrong next week when we get the CPI number, so we'll have to wait and see on that. But so far, it does look like they would rather hold rates where they are for a longer period of time as opposed to reversing course and starting to hike again.
Yeah, CPI, the next big test next week. And then, of course, we're going to have a lot more Fed speak that's still yet to come this week as well. Just, Brian, lastly, while we have you here, when you talk to your clients, if there are pullbacks and they're looking for opportunities to add into their portfolio or just hold on to cash right now, what is the strategy that you hear them employing most often?
Most often, they're actually looking at fixed income, looking for those opportunities to get these higher yields. And so one of the strategies that we really like following is when you think about the short end of the yield curve. So think about short-term investment grade. There's lots of great ETFs and mutual funds out there that you can find using the Yahoo Finance Screener. So short-term investment grade or AAA CLOs, things like that on the short end. But then longer term, look at higher quality. There's nothing wrong with, say, a 10-year Treasury ETF or something along those lines to get that type of income. So on the short end, you can go for higher yield. On the long end, you can go for higher quality.
Brian Jacobson, always great to talk to you. Thanks so much for giving us some time here and for your insight. IXIC Wealth Management Chief Economist and Strategist. Thanks. Well, we are just getting started here on the Morning Brief. Coming up, a tale of two ride-hailing companies, Lyft and Uber, moving in opposite directions on the back of those results. We will dig into the details next. And Shopify shares are plunging on expectations of declines in its gross margins. We're going to dive into that earnings report. Plus, Reddit shares getting a boost from strong results in its first print here as a public company. We will speak with one analyst, though, who's still skeptical on the stock. We've got all this and more. You're watching a Morning Brief.
A tale of two ride-sharing companies here. Shares of Uber and Lyft moving in opposite directions on the back of first quarter results. Uber sinking after reporting a surprise loss in the quarter, but Lyft seeing its active riders grow at the fastest pace since 2022. So there you're taking a look at Lyft first here. And some of the results here as we were diving into this both yesterday and then again this morning, pouring through some of what the remarks were that the company really gave, talking about the start to 2024, very strong first quarter results. David Risher, the CEO, talking about rides and gross bookings growing by more than 20% year over year here. And then also saying that they're on track to deliver on some of those full year goals with a higher level of free cash flow than they initially shared here. So that could be one of the reasons why you're seeing shares react positively as well here on that free cash flow projection.
Yeah, exactly. When you take a look at this print here, at least from Lyft, there's not many signs of any consumer weakness. When you take a look at a lot of these key earnings numbers here that the company is putting up, and it almost tells the story that Lyft seems to be getting better and better, or in a better and better position here as the quarters come on, because there's lots of questions about what exactly their competition is going to look like, or their ability to compete with Uber when it comes to obviously the dominant player within the space. But when you take a look at this report, it's improved outlook here for 2024, free cash flow conversion, healthier rider, also driver metrics as well. So that's a big reason here why we're seeing Lyft really perform up to expectations and exceed expectations in many instances here in its most recent quarter. And then we're seeing shares or the stock get rewarded as a result. Now on the flip side, bit of a different story when it comes to Uber. Some disappointment there around their earnings print, exactly that miss that we saw there. When it comes to exactly what the growth trends look like there, we saw a bit of a deceleration in bookings growth as well. So pointed to maybe possible saturation that we could be seeing within their market. So again, a very different story here. And as a result, you're seeing Uber shares sell off just a bit here ahead of the open. We're looking at a drop here of just over 7.5%.
Yeah, here's a few things to take away with this too. I mean, Uber, you're looking at the price right now, which is well above about $25 above where the company went public at, whereas Lyft is still trying to get to that level, get back to that level. It's been a different type of story for Lyft because they don't have the same type of diversification, especially across the eats or freight delivery type of, and I mean, it's not freight like putting things on a ship, but at the same time, it is trying to get things from point A to point B. Anyway, all these things considered, the diversification, both geographically and in service offering, has looked different between the two. All that said, for investors that are trying to figure out where the most opportunity within this ride-sharing industry is, the comeback story of Lyft has been really interesting over the past year. Shares are up by about 98% over the past 52 weeks here. So you got to question if there is more rotation into a company like Lyft, both on price right now and on potential valuation going forward from this point, given some of the announcements that they're trying to chart forth as well here. But Uber, not too shabby in aggregate here.
Yeah, that's a very good point. All right, let's move on to another name that's trending here in Yahoo Finance this morning, and that is Shopify. Shares plunging after announcing it anticipates decreasing gross margins during the current quarter as it deals with the impact from the sale of its logistics business to Flexport. Now, the company is saying that its revenue is also taking a hit as a result, and you're looking at shares falling nearly 20% here in the pre-market trading. Beyond some of those headline numbers here and that surprise loss, they're also facing some higher operating costs. That, of course, has been a headwind here for the company in most recent quarters. And then when you take a step back and you talk about the weakening macro environment or concerns around the macro environment right now, a cautious consumer, that, of course, will potentially and is already weighing on Shopify's results. And we're seeing more of a bearish take here on this print and on exactly what the current quarter could potentially look like here for Shopify.
Yeah, it's interesting. They're talking about seeing the strongest version of Shopify in the history. Outstanding Q1 performance, clear proof of the dedication to the new shape of Shopify. What that shape looks like, to your point, in a moderating consumer mindset in terms of where you're purchasing, is also something worth tracking going forward from here. But the gross merchandise volume, that was up 23%. Merchant Solutions was up 20% as well. And then it's interesting, as you look through some of the different areas that they did see more shoppability, some of what we would typically look at as the aisles here, it's going to be interesting to see where they see even more of that recurring revenue come in, especially given the gross profit. That actually grew 33%. However, investors still sending this lower here, pre-market right now, about 18%. All right. Affirm shares, we got to talk about this one. They're moving higher after reporting the third quarter revenue jumping 51% from a year ago. The company giving better than expected revenue guidance for the current quarter. The buy now, pay later company also seeing gross merchandise volume climb 36%. Hey, where else did you hear that? Yeah, we just talked about it. But anyway, all those things considered, one of the major things that I jumped to within this report as you're taking a look at some of the actuals versus the estimates beating top and bottom, one of the areas that they're actually seeing more purchase in, diversified growth for gross merchandise volume across all categories and products, with everything except for sporting goods and outdoor growing year over year. Not good news for Dick's Sporting Goods or perhaps some of the other sporting goods retailers. But here's where it got interesting. Categories such as electronics and home and lifestyle that underperform were growth contributors during this most recent quarter. Even they got in on the action here.
Yeah, you're seeing a bit of a shift then. It
Yeah.
highlights me how people are spending a bit differently this time around. What stuck out to me in this report was the delinquency trends and kind of the stability that we're seeing, at least when it comes to Affirm numbers, because the 30 and 60-day rates, they were essentially flat. 90-day delinquency rate, that actually fell. So what does this signal? Well, you talk about maybe potentially more sturdy growth, more durable growth here going forward, and that growth potential, what exactly that looks like here for fiscal 2024, and then the impact that this could ultimately have on guidance here for future quarters. That, of course, is one of the driving factors in this print as well, with shares up nearly 2%.
Travel and ticketing, also a major important driver, growing 35% year over year. That tells you that people are changing how they spend about vacation.
It's very true. All right, we'll keep right here on Yahoo Finance. We got much more coming up on the way. We've got the opening bell on Wall Street. We will be taking a look at how the trading day is shaping up. All three of the major averages look to open the day in the red. We'll be right back.
And there you've got a live look at the opening bell here. Take a look at the NYSE, where you've got floor and decor, or decor. It's a big debate in the newsroom here, how you pronounce decor or decor. But anyway, they're ringing the opening bell at the NYSE. And at the Nasdaq, no mistaking that pronunciation, Zapata AI ringing the opening bell there. Let's get a check of the market, sponsored by Tasty Trade here. We've got all major averages lower here across the board as we're taking a look at the global and international heat map. Let's zero this in on, of course, as us Americans would do. The S&P 500, you're seeing that down right now by about 0.4%. Here's a look at the sector activity that we're seeing out the gate. Staples leading the pack.
Yeah, you have Staples, one of only two. Healthcare, the other sector here, opening at least for right now, very, very early trading, but opening here in the green. On the flip side, you got consumer discretionary. Not a huge surprise when you look at some of those earnings prints prints out this morning. The stock reaction that we're seeing, that's under pressure here, off just around 0.8%, as well as communication services there. So two sectors that had been leading the way, also really leading the way when it comes to earnings results as well. On the flip side here today, they're actually falling under pressure here, as well as the real estate sector, off just around 0.7%. We got team coverage here, continuing that team coverage on the opening bell. Yahoo Finance's Jared Blickery is standing by with a closer look at some of this early action. Jared.
Thank you, Shauna. Let's go to the Wi-Fi Interactive. I am going to plot the year-to-date charts for the major indices. And what I want to point out here, here's the Dow. We've had a nice multi-day thrust off of these lows. Still about halfway to go between the high and the low here to get back to those highs. But the S&P 500 has really accelerated. All the major indices have cleared their moving average, the 50-day moving average. And now these record highs are in sight. As I've been writing, I don't know that we can get materially beyond them until we pass June. We do have a little bit of bearish seasonality, but in the meantime, it is risk on. And I got to track what's happening in the 10-year T-note yield. We do have a 1 p.m. auction today. We can see it's up by about 3 basis points. Given the fact that we don't have a lot of news this week, that 1 p.m. auction is going to get a lot of play here. And then here's the U.S. dollar index. Now, I'm going to show some candlesticks. You can see on a 3-month chart, we have 3 days up in a row. And this is significant because the dollar is the tail that wags the rest of the dog. And a lot of that has to do with multinational corporations, commodities, cryptocurrencies. Dollar affects all of them. So let's take a look at those sectors again. What I wanted to show, Shauna, you mentioned staples and I believe utilities. Staples is back to record highs. Staples and utilities, in fact, are the only two sectors that have managed to climb back to their record highs so far. A little bit defensive, but we'll have to see how this all shakes out. Like I said, it might be a case of selling the rips until we finally clear that May seasonality headwind. Guys.
All right, Jared, thanks so much for breaking that down for us. Let's talk about some of the broader moves that we're seeing within the market and the bond market here, because between sticky inflation, future potential rate cuts here, and wars playing out in the Middle East and Ukraine, it's reasonable to argue that we are currently in a macro-driven environment here for the market. But with assets now moving with unusual independence, at least according to our next guest, he's arguing that if you look just under the hood, we might actually be in a micro market. Here for more on this, we want to bring in Andrew Sheets, Morgan Stanley Global Head of Corporate Credit Research. It's great to have you here. So talk to us just about, when everyone is saying this is a macro-driven market, you're saying it actually might be a micro-driven market. Why?
Yeah, thanks. It's great to be here. So, look, I think it's very understandable. I think if we read the news, if we talk to other investors, all the focus is often on these big macro variables. You know, when is the Fed going to make its first rate cut? You know, where are interest rates going? Where's inflation headed? You know, some of these geopolitical concerns. But if that were the real driver, I think if it were these big picture issues that were driving the market, I think what you'd expect is a lot of different assets, a lot of different stocks, a lot of credits, all moving together, all moving kind of to the same side of the ship at the same time. And that's simply not what we see. I think this year so far has been unique in how independently individual stocks, individual credits are moving from each other. And I think that's important. I think that's a real sign that a higher for longer rate environment can mean that overall things are fine, but individually you have winners and losers. And it creates a really good environment for stock picking, for kind of active management, because individual stocks, individual credits are moving separately from each other, even as the overall picture is somewhat more stable. So I think that's an important distinction that we think really matters to markets.
I mean, Andrew, it just seems like for so much of the year, we've been trying to figure out, will they, won't they with the Fed? That's a macro. You have to weigh in all of these exogenous threats, also macro. I mean, where are the biggest micro indicators that are having a more outsized impact than those macro events that we've had to discuss and continue to keep tabs on?
Yeah, I think that's a great point. So I guess I think about this in a couple of ways. You know, one is, right, we went from the market at the start of the year pricing in almost 7 rate cuts from the Fed to the market today pricing in, you know, less than 2 rate cuts. And over that time, the market has been generally strong and credit markets have been strong, spreads are tighter. So I think the market has clearly shown that despite, you know, very different expectations of Fed policy, it can continue to operate. It can continue to be okay. And I think we see this in a more, kind of narrower level or more recent level where, again, after that GDP number, I think it was 2 weeks ago, where it looked like the headline GDP number was weak. We thought it was a little bit better, but the initial read of that was it was weak GDP, it was high inflation. What helped turn the market around? It was a very micro development around earnings. That earnings season has generally been pretty good in Europe, in the U.S. So I think you see that in the ability of earnings to offset some of the scarier macro headlines. And I think you see this just generally with year-to-date performance with, despite some big swings in Fed expectations, I think the market is telling you that it can handle that as long as other conditions are met.
So, Andrew, then is the market almost priced to perfection at this point? And then what does that ultimately mean here for investors identifying those best opportunities?
Yeah, so I think this is a question that really varies depending on what market you're looking at. For European equities, for example, we do not think that's a market that's priced for perfection. We still have reasonable upside to my colleagues' targets. We think the loan market in the U.S. kind of closer to my area of credit, where yields are still above 9% for U.S. loans. We do not think that's priced for perfection in the context of a soft landing. So it certainly, I think, varies depending on where in the markets you look at. But overall, we think that there are still opportunities around that are not yet kind of fully baking in the soft landing scenario.
Andrew, always a pleasure to get some of your insights. Andrew Sheets, Morgan Stanley, Global Head of Corporate Credit Research. Thanks so much for taking the time.
Good.
Switching gears here, Reddit shares surging on the back of its first report as a public company, but our next guest still skeptical about the stock. More on this after the break. Microsoft doubling down on AI, investing over $3 billion to build out infrastructure in Wisconsin. President Biden heading to Wisconsin today to make the announcement with Microsoft President Brad Smith. Yahoo Finance's Dan Halley joins us now. Hey, Dan, what do we know about this?
That's right, Brad. This is a $3.3 billion infrastructure investment from Microsoft in Racine, Wisconsin. This is the same place where President Trump had talked about Foxconn building a massive facility for displays. They ended up cutting that back significantly and not really meeting those ambitious goals. And so now Microsoft is moving into this space with this facility. It's going to be a data center. Obviously, with AI exploding, they need more data centers. Part of the issue that Microsoft said in their last earnings call was that the reason why they didn't see more AI revenue in the quarter was because they just couldn't meet demand for AI needs. So this will help them build that out. In addition to that, they're going to offer educational programs for nearby residents so that they can train up in AI, as well as a program to get local business leaders to start using AI. And so this is all part of kind of Microsoft's effort to kind of smooth the transition for companies into more AI use cases while continuing to build out the facilities that they need to run this kind of technology.
All right, Dan, thanks so much for breaking that down for us. Again, Microsoft shares, though, still under a bit of pressure here following the open, off just about 0.2%. Dan, thanks. Let's get to Reddit because shares there are surging after reporting revenues surging at 48% from a year ago in its first earnings release as a public company. Ad revenue alone soared 39%. The social media platform also giving revenue projections here for the current quarter that are well above the street's expectations. You're looking at Reddit now up just about 5%. Since the start, though, of trading, when you take a look at that max chart, you've got shares up just about 11%. So here we are today above $51 a share. For more on these results, we want to bring in Mark Shmulek. He's Bernstein Internet Equity Research Analyst joining us now. Mark, it's good to see you. So talk to us just about this print because it looks like, at least at first glance, there is certainly a lot to like within this report. You, though, don't seem to be convinced. Why?
Yeah, first, thanks for having me. And it was objectively a great first report or print out of the door for Reddit now as a public company. And the top line numbers look great. You know, revenue growth growing well above expectations, led by ad growth, which is what you want to see. And engagement growth or user growth is also kind of very strong. And so near term, we really like it as kind of a tactical play. I think they have some very easy compares. What we're starting to see is that there's just a really robust digital ad market at the moment. Management on the call last night shared, this is kind of one of the best brand markets for brand ad spend since 2022. And you've seen it reflected elsewhere, Pinterest, Snapchat, seeing this massive acceleration in advertising growth. And on the engagement front, a lot of that engagement has actually been driven by logged out users. So anybody who's been on Google has probably seen Reddit blue links show up more and more. It's good to get those users. They're probably slightly lower calorie users. That's been the biggest bulk of kind of their engagement growth. And, as we know that over the longer term, those are just tougher users to monetize.
Yeah, you're probably talking about me, Mark. I sometimes forget my password to Reddit, but don't tell any of the scammers out there that. Anyway, all these things considered, where is the biggest growth opportunity for Reddit right now? I mean, re-engaging with some of those users, as you were just mentioning a moment ago, but also on the monetization, it's more than just a platform where they've got to be able to have advertisers that are willing to run campaigns. There are other efforts that they need to put forward to monetize, right?
That's right. And so first is you want to bring advertisers onto your platform. So you need to have something to sell. So they've been building out kind of a suite of ad products, some of which look really similar to what we've seen elsewhere. We heard management last night talk about potentially getting into search ads. There's a lot of on-platform search behavior, video ads, which are certainly very popular right now across TikTok, Meta, YouTube, et cetera. So there's more products that they can bring to the table. And then beyond advertising, they do have the big AI data licensing deal with Google. There's a few other smaller ones that they've kind of mentioned. So there's, kind of call it a platter of monetization opportunities ahead of them here.
What type of additive do you think the AI and because of user-generated content and data that takes place on the platform, as we were discussing earlier, really exhibiting that human realm of conversations, what type of additive do you think that could be over time to the revenue, to the bottom line for this company?
Yeah, it's a good question, and so far the biggest deal is obviously the Google one to kind of ingest that real human kind of data into some of those generative AI, the Gemini results, and I think we'll see. If Google sees real value in it, that it helps kind of create more authenticity in the responses, not who can kind of scam the algorithm the best or flood the algorithm the best to kind of deliver whatever results they want. We'll see if the others kind of come on board. And I think that's one marker we're watching to see, does OpenAI get involved and do a licensing deal? Does Meta with Llama do a deal? Does Anthropic? And so, we'll see how valuable this data is if we see the other big foundational model builders follow suit.
Mark, talk to me just about what it would take for you to be a bit more bullish on this day. And when you take into account what we're learning from this report, it seems as though, although maybe too early to call, that it's almost turned a corner here in terms of profitability, what that timeline looks like. It looks like user engagement, though, is still there. What do you need to see in order to be more convinced?
Yeah, I think the truth quarter, as I call it, it's going to really start in the third quarter, where you start lapping the change to kind of the Google algorithm. The compares get a little bit tougher from a monetization ramp perspective. And then we'll see, how kind of real and durable some of their efforts are that are underway. Can they actually take some of these logged out users and convert them to being more kind of consistent, engaging users? Can they know enough about the users to be a valuable medium for advertisers to deploy, ad dollars, not just for top of funnel kind of brand campaigns, but real, commercial intent driving purchasing behavior type of ads? And then we'll also see if any of those follow through AI deals show up. And so, we're watching it closely, and I think they've got another quarter at least ahead of them with probably very solid results on the table. And we'll see in the second half of the year of, whether some of the more challenging efforts that are required for me to get more constructive at this price show up.
For investors that are even looking out to that third quarter, as you were mentioning here, what are some of the dynamics that we could see play out on a Reddit as a result of an event like a general election season?
Yeah, it's an interesting one because generally speaking, during an election season, brand campaign platforms tend to do quite well. You've seen it in the past with YouTube, as the election-based advertising is not an insignificant number. We'll see how valuable kind of the Reddit base is. It's certainly not the core Reddit advertiser today. And so it's kind of 50-50. It might be a platform where they'll actually see the influx of political-based ads show up as well. Or it could go the other way where, kind of their current advertisers tend to pull back during an election cycle because it does tend to get dominated, by kind of political-based ads.
Mark Shmulik, who is the Bernstein Internet Equity Research Analyst. Mark, always a pleasure to speak with you and get some insights.
Likewise. Thanks for having me.
Certainly. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Another chapter in the closing saga of collapsed crypto exchange FTX. According to a court filing, the company is saying almost all of its customers will get their money back. The company is saying it owes creditors about $11.2 billion, and the plan says that customers whose claims amount to $50,000 or less will receive approximately 118% of the amount of their allowed claim. The reorganization still has to be approved by the bankruptcy court here. It's worth noting that, of course, when the company collapsed, when FTX went down back in 2022, late 2022, Bitcoin at that price back then was somewhere around $20,000. And as we're taking a look at BTC USD here today, I don't know if we have the chart that we can toss up here on the screen, but we should still be north of $60,000, $62,000 if you want to round up at home. So all these things considered, there's kind of a hefty delta between what some of these people may have owned within FTX and what they will be owed as a result of this settlement too.
Yeah, that's such a good point there, Brad, especially when you take a look at the behavior here of Bitcoin ahead of this bankruptcy filing, right? Because it had sold off just about 50% here ahead of that. So when you compare that, the time of the value there, what it was from this bankruptcy filing to what it was today, seriously a very, very large gap. When it talks about where this funding is going to come from, nearly 100% of it, more than 99% of it coming from what they had raised from the company's investment portfolio. And within that, reports here that Anthropic, they're holding there. They sold the shares there and that for nearly $900 million this year. So again, many of those who have been affected by this filing are going to get 118 cents, I guess, on the dollar here when it comes to when it all evens out. But again, like you were saying, this has to be approved. There's still a couple of processes that need to take place before this is finalized. But I think that this doesn't really remove the uncertainty aspect surrounding crypto, surrounding Bitcoin, right? And why so many people even remain on the sidelines when it comes to these type of investments. Yes, you can make the argument FTX is very much a one-off type of situation, the fraud, the allegations, everything that had been confirmed there and found in court. But still, when people think about investing in crypto, I think there is a hesitation here with a large portion of the investment audience who is a bit skeptical and a bit nervous of putting their money in crypto because of everything that has played out over the last several years.
Well, we've had some major profiles that have tried to emerge and cement themselves as Bitcoin or crypto barons instead of making sure that they were cementing the service or the product that they were providing to actually sustain the well-being of sentiment for the industry at a whole here. And what do we mean by that? I mean, you look at FTX and Sam Bankman-Fried now, who has also, for FTX, they've had to previously approve a settlement with BlockFi as well. That was the largest creditor of FTX. There have been continued missteps for the people who were looked at as barons. That's put a dent in the sentiment, and it almost points exactly back to why Satoshi, who wrote and pioneered the Bitcoin white paper, is so anonymous, because it wasn't supposed to be annexed or be able to be made or broken by one figure and one figure alone here. And so that was the prevailing origin story for Bitcoin and cryptocurrency here. Larger question here of now, when you've got so many large financial institutions involved and invested, where there's going to be more of an effort to make sure that there is regulatory practices that actually solidify the sentiment from this point forward.
Yeah, exactly. We were talking a bit to Anthony Pompliano about that yesterday, in just in terms of what exactly that could potentially look like here in the years to come. All right, well, coming up next hour, Madison Mills is going to be here with me for our new show, Catalyst. We are going to be breaking down what's next for the chip sector and everything you need to know.
I'm looking forward to that. We got our Pringles ready outside, and you got other chips that you're going to be talking about too. Also, later on in our 11 a.m. hour, stay tuned for Wealth, where we'll be discussing why new home buyers are drawing a line at fixer-uppers. Yeah, we're talking to you if you're fixer-upping a home. Fixer-upping, that's a new one. You're watching Yahoo Finance.
Today I'm here in New York City. I'm Shauna Smith alongside Madison Mills. Welcome to our new show, Catalysts.
From equities to commodities, we are decoding trends and uncovering the drivers behind today's market moves.
Our team of experts, they are here to help you navigate all the possible outcomes to help you make the best decisions for your portfolio.
It's Wednesday, May 8th, so let's dive into the catalysts moving the markets today. Earnings season entering its final stretch here, testing the market's strength in the last few trading sessions. With 80% of the companies in the S&P 500 reporting already, we're on pace for a 5% earnings growth rate in this first quarter. That is the biggest gain in almost 2 years, according to FactSet.
We're also keeping an eye on crude this morning. Oil futures extending losses down roughly about 1% on concerns of rising inventories. That's putting pressure on prices. This comes after the U.S. Energy Information Administration, the EIA, cut its 2024 world oil demand growth expectations and also hiked its output forecast for the full year. The EIA is set to release its inventory data later this hour.
And Semi is feeling some pressure this morning after the Commerce Department confirmed that the U.S. is revoking certain licenses for chip exports to Chinese tech giant Huawei. The agency saying the decision came during regular assessments into how the agency can protect U.S. national security and foreign policy interests.
Focusing in on the chip sector here this morning, the U.S. Commerce Department is considering restricting the export of proprietary or closed-source AI models. This is according to a Reuters report. Now, this is just the latest provision meant to safeguard AI intelligence systems from China. Now, just in March, the administration halted shipments of NVIDIA's more advanced AI chips to the country. And why we're bringing this up is exactly what this means for so many of the chip makers here in the U.S. When we talk about this report and the impact that this is ultimately going to have on U.S. names, Qualcomm and Intel are two names that we're talking about here this morning. And you had Intel coming out saying that the ban is going to impact its second quarter revenue. So again, what that pressure could ultimately look like here in the coming quarters is something that investors are taking note of, and what people really need to start to assess and realize here when they're starting to make some of those strategic movements here for their portfolios.
Well, and it's a great point, Sean, on Intel kind of reversing some of their guidance for the second quarter here, as you mentioned. And Steve Sosnick, friend of the show, telling me this morning that that is part of what's leading to some of the downward action that we're seeing this right across your screen in the broader industries. Now, what's interesting here, though, is that Intel and Qualcomm, the business they were doing with China was already really limited. So I wonder to what extent part of this is Intel already having a really tough time and saying, hey, what a great excuse to tell investors about with why we might be having some of this bad news here. I am curious, too, how U.S. policymakers are going to be interacting with China, specifically as we get closer to the election. Shauna, are we going to see more like hawkishness in their activity, particularly too as we have this AI expansion? Are we just going to hear more and more of these restrictions?
Yeah, you would think so. When you take a look at the Biden administration and a potential Trump presidency, both sides, you can make the argument that they have taken a tough stance on China. You could argue that maybe if Trump were to be reelected and back in the White House come November, he would be even tougher on China. That's generally the sense that we have been getting from strategists, from economists to industry experts here over the last several months. And then you also have to talk about what exactly this means for China and the potential backlash there, and ultimately what some of those retaliatory measures could potentially look like down the road, and what companies are then positioned to almost be hit the hardest here when we talk about those future retaliatory measures as well. So when you talk about companies that have a large exposure to China, they're watching these developments and escalation here in the tension between the two countries. That's something that's on investors' radars here across industries.
That's a great point, and came up when Chinese officials were saying that the TikTok ban situation opened up a tit for tat. So definitely something we're going to continue to monitor here. Well, markets are on edge ahead of a busy week for bond sales. $42 billion of 10-year notes on sale today. Now, this is part of the record-breaking $125 billion worth of treasuries that are up for auction this week. So what does the demand at these auctions tell us about investors investor sentiment. For more on the fixed income space, we are joined by Mohit Mittal, PIMCore Core Strategies CIO. Thank you so much for joining us, Mohit. I'm curious about your thoughts on the demand that we're seeing at these auctions coming in a little bit better than we had perhaps anticipated. What is that telling you about the action that we're going to see moving forward in the yield space?
Thanks for having me. Yeah, I think as you mentioned, the demand has certainly been pretty good with respect to Treasury auctions. I think when we take a step back, we have seen a correction in valuations. When we started the year, 10-year was at 3.9%, where we were a couple of weeks ago, 10-year had reached around 4.7%. Certainly a good amount of repricing. Essentially what that repricing has done is it has recreated value in fixed income. I think that value essentially implies that on a go-forward basis over the next 1 year, 3 year, investors can expect healthy return in fixed income under most scenarios. And then in a scenario where growth starts to slow down, investors can have even a double-digit return potential in fixed income, which is why you are seeing good amount of demand, both in the Treasury auctions, but broadly speaking across fixed income flows.
So when you're talking about that investment opportunity there, more specifically, where do you see the most opportunity for investors given that demand that we'll likely see?
Yeah, so I think from our perspective, we see plenty of opportunities in high quality fixed income. Within the US space, I think agency mortgages is one area where we see a lot of value. That sector underperformed over the last couple of years, particularly post Silicon Valley Bank, as some of the bank portfolio liquidations led to cheapening in that space. When we go outside of US, we are seeing value in some of the high quality sovereign and high quality credit expressions outside of US, where growth has been somewhat weaker, where inflation is getting closer to central bank's target, for example, in countries like UK, in Australia, in Canada. And then when we go beyond government and high quality mortgage market, even areas like high quality investment grade, and then even FX or emerging market foreign currency space is offering value for investors to utilize to construct a high quality fixed income portfolio.
Well, Mohit, I'm curious about your take on that, particularly because in reaction to what we heard from Neel Kashkari yesterday saying that we could have to stay higher for longer if we can't tame inflation. Is that a catalyst for yields at the back end of the curve to also stay higher for longer? And then would that make the long end of the curve more attractive to U.S. investors?
Yeah, I think yields can certainly stay higher for longer. I think the argument for higher for longer is inflation persisting above central bank's target for some extended period of time. Another argument for higher for longer is the ongoing fiscal deficits, where, as far as I can see, we can expect somewhere around 6 to 6.5% deficits, irrespective of the election outcome in the US. So in that framework, yields can certainly stay higher for somewhat longer, but market is already pricing that. When we look at 10-year around 4.7-ish, 4.6%, 30-year around 4.6 to 4.7%, that is already pricing in some form of higher for longer. I think one of my colleagues Tiffany Wilding, has done a pretty interesting work with respect to central bank policy. And the assessment is that at this point, central bank policy is shifting towards what we would call an opportunistic disinflation. Under that paradigm, the central bank can remain focused on getting inflation towards target, but at the same time also be mindful of the downside risks that are posed to unemployment rate or employment when the monetary policy is already restrictive as it is currently. So under that framework, even if the inflation doesn't get to 2%, inflation gets to 2 point something, somewhere closer to 3%, you could see Fed cut rates 1 to 2 times this year. And in a scenario where inflation persists somewhat longer, then the Fed can keep rates here for some extended period of time. But if growth was to come down, then there's plenty of room for Fed to cut rates much more than currently expected. And that could lead to a pretty meaningful upside return in fixed income.
To what extent does the risk of the deficit play into your view long term? We're hearing a lot more about that looming elephant in the room lately.
Yeah, so I think deficit is a concern. I think 6.5% area deficit for an economy that already has nearly 100% debt to GDP, and where the nominal growth potential is, call it somewhere around 5-ish%. So essentially that means that the deficit is higher than the nominal growth, which means that over time, debt to GDP in the US economy continues to grow higher. So it's certainly a concern. I think the way it plays out is probably through the term premium in the US rates market, which is why our preference is towards more intermediate bonds, towards more 5-year, 7-year point of the curve relative to a more longer dated point in the curve.
Mohit Mittal, we really appreciate you taking the time to join us here this morning. PIMCO Core Strategies Chief Investment Officer. Thanks so much.
Thank you for having me.
Well, coming up, Tesla's legal troubles continue. The Justice Department reportedly examining whether Tesla misled consumers over its autonomous vehicles. We'll tell you what the long-term effect could have on the stock on the other side of the break.
Let's do a check of the market sponsored by Tasty Trade. Looking at a lot of red here. The Dow basically flat. The S&P down 0.2%. And the Nasdaq down 0.4% here. The Dow just barely slipping into the green. But it's interesting to see this movement, particularly after we've seen a couple of days of the market rallying. But it was on pretty light volume here. So we might be seeing a little bit of profit taking this morning, especially after some negative company news when we have earnings from a company like Uber pushing that stock down. We also have idiosyncratic news with Intel and Tesla putting a little bit of a damper on the trade this morning. And that's why we started to see futures kind of ticking down after those reports and still seeing that negative action in the trade today.
Tesla shares sinking after U.S. prosecutors are reportedly investigating whether Tesla committed securities or wire fraud by misleading investors regarding the capabilities of their self-driving technology. Now, this is according to a report here from Reuters. Yahoo Finance's Praj Subramanian has the latest details on that. And Praj, you can see the concern playing out here for Tesla. Shares off just about 2.5%.
Yeah, reports of this probe into whether they committed, wire fraud with the communications to consumers about their abilities with the self-driving software, and also securities fraud. Were any investors induced into buying the stock because of what Musk was saying? There's videos of Musk saying, or videos of Tesla saying that the driver is only sitting here just for demonstration purposes. The car is self-driving. So you have a lot of puffery here. That's the big question: is it salesmanship? Is it we have the best #1 self-driving software? Like, you hear that all the time. Is that just sort of like a sales tool, or is it actual? They knew the system was unsafe or was not reliable. They still said it anyway that it was in order to profit. So it's a lot of. They got to prove a lot there for fraud, but it's still not a good look right now. And the probe is ongoing. You don't know what's going to happen with that, but it's not a good look for their software.
Well, that's my question: is what is really new about this report? Because we already know that the Justice Department has had questions about the self-driving technology, and Tesla has talked about that in some of their filings. So I'm curious, what stands out for you as the newest bad news for them here? Right.
So last year, Reuters reported that the probe was about sort of the software itself, right? Is it just defective? And then did they knowingly put it out there criminally, right? Now it's this is fraud. Is it outright fraud, not only for consumers, but also investors? And there's going to be an investor lawsuit coming out after this, and if not already. So that's the new wrinkle here. Again, it could go away. They could resolve this. It could go away. They could pay a fine. But at the time right now, it's beyond just, because NHTSA also is pursuing, they want all this data from the crashes to kind of show that did Tesla's remedial efforts when they did the recall, were those effective? And they question whether it is.
All right, Praj, great as always. Thank you so much for joining us. We really appreciate it. Thank you so much. For now, we are going to go over to our guest, I believe, because Tesla stock is under pressure following the movement that we are seeing this morning. Dan Levy is joining us here. Dan, thank you so much for being with us. I hope that you were able to hear Praj's great commentary on this, and he was talking about the question about whether or not this really is fraud. So I'm curious, from your perspective, Dan, to what extent are you concerned that this could be fraud from Tesla?
Yeah, good morning. Thank you for having me. I think that broadly for Tesla, and I won't comment to the report itself. I think Tesla right now is in the process of validating and demonstrating the capabilities of FSD. Obviously, there's one side of this that we're well aware of is consumers and consumer uptake and getting consumers to appreciate it. But on the other side of it is the regulatory front. And, in general, we view the regulatory side as a risk that needs to be monitored. It's one where so far Tesla has been able to keep the functionality that they have out there. But the regulatory side is a risk that certainly does need to be monitored on the FSD front.
Dan, just give me your sense right now of Tesla, how it is positioned following the run-up that we have seen since earnings, and the current valuation of the stock right now, given some of those macro concerns that you were just talking about. How big of a risk do you see that potentially being here then to the downside?
There's a lot of uncertainty for Tesla right now. From a fundamental standpoint, things are obviously a bit more challenged. I think people are well aware that EV demand is pressured. Their demand is under pressure. We obviously saw that with a very soft 1Q volume estimate. At this point, people are forecasting volume to be largely flat. We're flat on the year, which was once sort of an unthinkable thought for Tesla, to have flat volume on what should have been very robust growth. So the fundamental side is challenged. On the other side of it, you have an investment thesis that's in pivot, and I think that there is uncertainty because the stock or the narrative is pivoting away from what was viewed as some certainty around vehicle sales, leveraging a cost advantage, and instead leveraging bets that people view as possibly binary, right? The push to autonomous, the push to robotaxi, these could be potentially largely disruptive bets, but they're binary. People just don't know what the outcome is. And so that's why I would say there's an air of uncertainty.
Right, and people are maybe buying the story about full self-driving versus the reality of it being here. But I want to get your take on the robo-taxi here as well. Does today's news change what we might be anticipating from the robo-taxi moving forward?
Well, I think I don't know that this really changes the narrative. I think we're waiting for a couple key things on robo-taxi. One is certainly as it relates to today, any updates on the regulatory front. But we're waiting to see, any updates on take rates. And then we have an AGM coming up, which is a key event to watch for. And then certainly August 8th is the robo-taxi launch. And clearly this narrative needs to play out both from the FSD side, which is more of a, what we view to be driver assist functionality, as well as the fully driverless technology that Tesla has, alluded to, but really hasn't given us much meat on the bone.
All right, Dan, we want to switch gears here and talk about another EV player that's certainly moving here, at least to the downside today, and that's Rivian, the EV maker extending its losses. Shares are down just about nearly 7% right now in early action. When you talk about the disappointing quarterly loss that the company reported, they're doing this amid this effort here to revamp their manufacturing operations. They're also trying to boost, ultimately, the output here for EVs. How do you see Rivian positioned within this increasingly crowded EV space?
Look, we think that Rivian has a really impressive product, really good technology. So we like what's going on there. But we think at the core for Rivian is a key challenge on narrowing costs, right? First quarter was a fine quarter relative to consensus expectations, but it was still sharply negative EBITDA, all the more so on free cash flow. And I think what people are waiting to see is, they've communicated a path to reaching gross profit break even by the fourth quarter. The factory re-rate that they just underwent, or that they're in the process of going through right now, is going to be a key opportunity to drive cost reduction. But in many ways, we think this is a show me story. And then on top of that, you have tough demand where there's potentially price pressures, which could further pressure the path to profitability. So great product, really good technology. But the question is on the path to narrowing those costs and reaching break even and ultimately profitability.
Well, Dan, according to the DigiTimes here, Apple is in talks with Rivian about a possible partnership. What do you think the likelihood of that is, and what does it mean for Apple moving forward, particularly after they've moved past the idea of an Apple Car and instead invested into AI?
Really hard to say, and it's unclear, if there's any substance to that. I think in general, Rivian is constantly reviewing or considering the opportunity for strategic partnerships, any of that could help. Certainly on the investor side, I think people are always watching for the opportunity for a strategic to come in and help Rivian in that regard. But right now, I think the core focus for Rivian really is on reducing costs and driving toward profitability. That's really the core focus right now.
Dan, does Rivian need a partnership like Apple?
Not necessarily. I think right now, like I said, the core focus for them just needs to be on narrowing costs. And as you could see with Apple, they've basically exited the car market, right?
Mm-hmm. All right. Well, Dan Levy, always great to have you. Thanks so much for taking the time to join us here this morning. Barclays Senior Autos Analyst. Thanks.
Thank you.
Anheuser-Busch shares are rising after reporting better than expected results in the first quarter. As slumping sales in the U.S., they were actually offset by gains that the company saw over in Europe. We're looking at a move higher of just about 4%. Brooke DePalma has those details for us. Brooke.
Yeah, good morning to you. Both shares jumped as much as 5% at the market open this morning, largely because Wall Street was really impressed by earnings and a revenue beat, so both the top and bottom line. That earnings beat came in at 75 cents, and that was largely driven by stronger than expected margins. Revenue grew 2.6% year over year to $14.55 billion on higher pricing, but that was once again offset by volume declines. And if we take a closer look, overall volume came in higher than expected, but still down about 0.6%, and largely driven, as you could see here, by that North America segment of the business, where volume declined 9.9%, largely due to declines here in the U.S. because of that 1-year anniversary of the Bud Bud Light boycott. We did see sales to retailers as well as sales to wholesalers down about 10 to 13% for both segments as those grocery stores and retailers restock their shelves this spring. But the company did say that they are improving gradually from May 2023, and now market share here in the U.S. is roughly flat compared to last year. But this decline was largely offset by Middle Americas, especially within Mexico. They did call Mexico their second market. We did see increased volumes there, largely driven by Corona. We also saw EMEA, particularly Europe, have strong volume growth. Revenue there also increased in Europe, and that was largely driven by pricing and premium brands that are doing well. But largely there is a renewed focus here for Anheuser-Busch to really focus in on what they believe consumers need and what sort of connection they want from this beer giant in terms of promotion at live music events as well as sporting events. And of course, we've heard from so many other companies that they're picking up share from these year-over-year losses from Bud Light. And so the competition is brewing, I guess you could say, but the competition definitely is still very apparent across the board as these beer makers really look to capitalize on that loss that we saw last year.
Well, I loved that.
Intended.
Thanks for joining us, as always, Brooke. Really appreciate you. Thank you so much. Well, Shopify shares are plunging this morning after announcing it anticipates decreasing gross margins during the current quarter. This comes as it deals with the impact from the sale of its logistics business to Flexport, with the company saying its revenue is also going to take a hit. Now, what's interesting here is that we did see a 23% jump in their Q1 revenue, and merchants were selling more through the e-commerce platform. But again, they do expect that to slow down. That does feel like an interesting economic indicator to me, particularly given that we saw a lot of selling decreasing at the likes of Etsy and eBay and their earnings. So it's interesting to see that bifurcation, but looks like that gross merchandise volume raise was just not enough following that logistics sale that took a big headwind for them, about 300 basis points there.
Yeah, we're seeing that affect clearly the most recent results. Also the prospect that this could potentially weigh in current quarter results as well. You're looking at a loss here of nearly 20%. Putting that in perspective, we could actually see the biggest intraday drop here for Shopify on record if we do remain just around those current levels. So an important number here to keep in mind. And as we stand right now with around $61 a share, we could see maybe the lowest close that we had seen since November. So we are seeing some material selling here on this name on the heels of those results that surprised the loss that you were just talking about after the sale of its logistics business. And then even beyond that, given the uncertain macro environment right now, given the fact that the consumer is maybe pushing off some of their spending or reassessing their spending plans, that ultimately is going to weigh on Shopify's business here going forward. So you have the fundamental side of the business, also some of those macro concerns there impacting Shopify's, current quarter, most recent quarter, the current quarter right now, and then also potentially the second half of the year. So I think all of that on the minds here of investors for Shopify today.
That's a really good point, Shauna, and it definitely tells us a lot about the sector in terms of consumer spending as well. Well, the EV sector in focus on Wall Street today, but the clean energy transition in the U.S. going well beyond cars. It also involves upgrading the electrical grid to support increased power demand for AI and data centers. So which companies will likely benefit from that transition? Yahoo Finance's Inez Ferre has the list for us. Hey, Inez.
Hey, Maddie. Yeah, and we saw how higher interest rates last year put pressure on the clean energy sector, but surging electricity demand is expected to benefit companies working on renewables. So this year is different. Improving infrastructure, incentives from the government's Inflation Reduction Act, the IRA, that is aimed at accelerating the transition to green, domestically produced technologies, are also expected to lift the sector. So which of the companies are we looking at? Well, on our clean energy chart here, you can see Vernova. This is the company that just recently spun off out of GE, and the stock is up 17% since going public. This is a renewable energy company. They make gas turbines, they make wind turbines, and analysts are bullish on this stock because of increasing electricity demand and also grid investments. You've got 7 buys, 4 hold, and 1 sell on this stock. We're also taking a look, by the way, this is a year-to-date chart. We're also taking a look at First Solar. This is the largest supplier of domestically produced solar modules. Their backlog goes into 2027. Year-to-date, the stock stock is up 11%. Goldman Sachs recently in a note talking about how First Solar also has direct partnerships with data centers like Microsoft, for example. So bullish on that stock. And then we're also taking a look at the utility space, which, by the way, utilities is the third best performing sector out of the S&P 500 this year. And we are taking a look at NextEra Energy, up year to date, up 19%. This company delivers energy that's in the form of renewables, natural gas, also nuclear. And their CEO in their latest earnings call talked about the redomestication of industries in the U.S. being a tailwind for this company, data center energy usage also being a tailwind for this company. 17 buys, 5 hold, and 1 sell. So while we do see in the overall renewable space, we are still seeing weakness in that area, we are seeing companies that are these bright spots within that space, especially with the expectation of interest rates being cut later this year, guys.
Some that are well positioned here potentially for the coming years. All right, Inez, great stuff. Thanks.
Thank you.
We've got much more of your market action ahead. You're looking at the Dow up just around 21 points of trading just above the flat line. On the flip side, S&P and Nasdaq under pressure here in early market trading. We'll be right back. You're watching Catalyst.
So much attention here at the Milken Institute conference on inflation and the outlook for interest rates, but maybe we haven't talked enough about the global outlook and some of the biggest risks ahead. Let's bring in President at Lazard, Ray McGuire. Ray, good to see you again. It's been a while. Appreciate it.
Good to see you both. Great to be here.
In person. One of the biggest risks, I don't know if we talked enough about, is China globalization risks. What are some of these conversations like with clients right now?
So I would separate the lens in two parts. One, and I'm going to come back to clients because the views for the clients are somewhat different. Not diverging, but different focus. What's in front of us and what's ahead of us. Today, clients are thinking about impact of inflation, the markets, valuation, both the asset management clients as well as the corporate clients. That's what's in front of. What is the Fed policy? What is it going to do with borrowing rates? How does that reflect in the valuation if I want to monetize, if I want to go fund a transaction? For the asset manager, for the corporates, what's my currency if I want to make a strategic transaction? Reliance on equity as a source, stock as a source. The benefit of which is that I get to share in the upside and I get to share in the synergies. So that's what's in front of us. What's ahead of us is, as you've described, what's taking place geoeconomically and geopolitically. The global north and the global south. The dependence that the global north, especially America, has on the global south is not insignificant. For example, as we think about one of the macro trends, energy transition, if you look at the dependence that the U.S. has on the global south, China refines 70 to 90% of the precious minerals that are necessary for energy transition. If I look at the continent of Africa, the source of many of those raw materials, or Peru or Chile. So I look at the global south and see the dependence, unless we somehow figure out how to invest so that we become more self-reliant, we have exposure which is not insignificant. Today we're energy secure. Tomorrow we need to make certain that we're as energy secure tomorrow as we are today.
So from the perspective of your corporate clients, when you think about the over-reliance on other countries, does that drive investments as a way to safeguard the future? How do you think they think about that right now?
The answer is, well, not only from a corporate standpoint, from a sovereign standpoint. The CHIPS Act, as an example, the recognition that we need to be able to manufacture our own chips, to perfect the manufacturing of chips. So yes, for the sovereigns, and for the corporates, absolutely. And what does that translate into? We now have 3 or 4 of the large tech companies going to put $200 billion investment into capital expenditures. So yes, corporates are thinking CapEx. How do I invest today? Data centers, as an example. Energy sources. Remember, in order to get to AI today, it takes up 4% of the country's energy. The predictions by 2030 takes up 25% of the country's energy. So we have to build energy sources in order to be able to power anything that happens in generative AI. So yes, our corporations are actively thinking about how they go through and make capital expenditures for the future.
Are corporations prepared correctly for either election outcome or the presidential outcome in November? I get the sense that CEOs they know it's there, but they're not really planning their business for either outcome yet.
Well, I think that it may not be visible, but corporations at moments in time like this go through scenario planning. We try to help them out. We have a geopolitical advisor group, which is populated by some of the best thinkers on the planet. And we put a lot of thinking in scenarios of what happens with this election outcome, what happens if there's a different election outcome. So the answer is yes, they're thinking actively about it. Our group is very active globally. And so the answer is yes.
What's the worst outcome? Care to share? What's the worst outcome?
There are a few scenarios out there to which we need to attend in order to be prepared.
Well, I guess my question would be, if we're talking about the U.S. election, are the scenarios between a second Biden term or Trump term really that different from a corporate standpoint?
They could be, but remember,
because
across the world, across the planet, you got 50 some odd elections. So look at the risks that we have as we think about investing in the supply chain, offshore. There are 2 fundamental risks that investors look to. One is currency, and the other is political risk.
So let me ask you about that investment piece of it. You mentioned AI, you mentioned supply chain. these are massive projects. I mean,
They
we were
are.
talking about the CHIPS Act, $39 billion in subsidies. You look at what's happening in Europe, more than $40 billion at a time when rates are still incredibly high, or not incredibly high, relatively high, I should say. How do companies make that calculation about investing in the future, but knowing that that debt they have to incur as a result is still going to be pretty high?
So the question is, because these are so fundamental to how companies and the country operates, think of a scenario if we don't make the investments. So the answer is, from a return standpoint, we need to make sure that we're risk adjusted to have the appropriate returns, but we also have to think strategically. Remember, strategy drives financing in the corporate world. And even in the asset management world, strategy drives how they think about allocating. Today we have $10 trillion of capital on the sidelines deciding how it allocates itself in order to generate a return for the shareholders. We have to do the same thing in terms of how we allocate our resources. So companies are thinking very strategically about how they go about doing this. And so yes, the risk profile is critical. They need to make returns for their investors, for their shareholders, and we advise them that is a primary concern. But we also advise them on how they remain competitive. They're not incongruous, they're one and the same, in order to maintain the focus on making sure that they do what is necessary as a corporate citizen. So we're seeing all of it come into play at a moment in time when you have such geoeconomic and geopolitical challenges.
We've spent decades doing big deals. One of the most celebrated folks on the street doing deals. What's companies' sense on the regulatory environment? Are they tepid on trying to do a big deal with a backdrop like this?
So you're great to ask the question. That's a headwind. And so corporations are trying to figure out as they go through and assess how they're going to grow and grow strategically, will there be impediments to a strategic combination? And that has become a factor here in ways that it has been historically, maybe not as profile as it is today.
Does it
So
hurt,
they're going through
does it
that
hurt purchase
calculus.
price? Like purchase price, and maybe there's more breakup fees in any potential deal?
You'll see it get played out in different transactions.
Yep.
But the risk, apart from the economic consequences, the strategic consequences, and remember, the vast majority of these transactions are strategically driven. Very rarely in this environment are things just solely economic. And again, strategy is driving financing. So the answer is yes. As you think about a strategic transaction, you have to ask yourself the question and get as much advice as you can on what the likely regulatory response is going to be. That is now part of the calculus.
To pick up on Brian's point, though, when you talk regulation, it's not just about concerns about antitrust getting flagged. There's also concerns about any kind of foreign investment getting flagged, particularly in the tech space too. And I wonder, as somebody who has been in this space for a while, where do you see this all going to?
Where's it all going to?
Yeah.
You know, it will play out for so long as we make the investments to remain competitive and get beyond the divisiveness, which we have to do in order for this country's best days to continue to be ahead of us. We got to make those strategic investments. We have to reduce our exposure to the supply chain. We have to reduce that risk profile.
You're talking about foreign supply chains.
Foreign supply chain. Today we're energy secure, admittedly based on traditional energy sources. Tomorrow we need to be energy secure and technologically secure. Remember, today we're the most advanced technology that exists anywhere on the planet. We have to maintain that lead, which means we got to continue to invest.
All right, we're going to leave it there. The President Lazar, Ray McGuire, good to see you again. We appreciate it.
Great to see you all.
Thank you so much.
Thank you.
U.S. chip production is expected to skyrocket over the next decade, bolstered by incentives from the Biden administration's CHIPS Act. Here with more on this is Yahoo Finance's Dan Howley. Dan.
That's right, Shawna. This is according to a report by the Semiconductor Industry Association and Boston Consulting Group. And essentially what they're saying is that the CHIPS Act should be a success as far as getting the U.S. Back up when it comes to building chips onshore. And so let me just go over some of the numbers here. They say that there's a 203% projected increase in fabrication capacity from 2022 to 2023. That's compared to an only 11% increase in the prior decade from 2012 to 2022. Now, fabrication is essentially a place where they build chips. So they call them fabs because it's a fabrication facility, but it's just a factory where they build chips. The other thing to point out is, and this is very important, the U.S. is going to grow its share of the ability to build advanced logic chips. These are chips that are below 10 nanometers when it comes to the size of the transistors. So think of what you have in your iPhone, your iPad. Apple just announced yesterday a new 3 nanometer chip, their M4. We don't build those in the U.S. They're mostly built overseas, but this is going to boost that to 28% of global capacity by 2032. And again, in 2022, we built 0% of that. So that means that the U.S. is going to be increasing its ability to get these kinds of high-end chips out the door from within the country, and that should help with supply chain bottlenecks in the future. And this all comes obviously as a result of the tensions with China, and then also the pandemic, where the supply chains were just completely disrupted and there were chip shortages across the world. So the idea here then is to get more chip capacity on the ground in the U.S. so that we can kind of avoid those in the future.
All right, Dan, thank you so much, as always, for joining us. That was our very own Dan Howley, our in-house tech expert. Appreciate it. Well, rideshare earnings in focus with both Uber and Lyft reporting. Uber is falling after reporting a surprise loss in the quarter, including a $721 million loss related to the company's revaluation of equity investments. Meanwhile, Lyft seeing gross bookings jump 21% from the prior year. Its active riders growing at the fastest pace since 2022. Here with more, we have John Blackledge, TD Cowen senior analyst. John, thanks so much for being here. I mean, talk to me about the bifurcation that we're seeing here. Is this an indication to you that consumers are getting kind of tired of Uber's pricing and they're switching over to Lyft, or is it a different story?
Yeah, I don't think so. I mean, yeah, let's unpack it here. We'll start with Uber. You know, on the 1Q results, so the gross bookings were up about 20% year over year. That was slightly below our forecast as mobility gross bookings and trips were impacted by lower than expected LATAM results, but EBITDA beat solidly, 5% above consensus. And then the 2Q guide was fairly solid. Gross bookings on a constant currency basis up almost 21%. EBITDA guide was kind of in line with consensus at the midpoint. I think the shares rate are down right now for two reasons. Number one, lower 1Q mobility gross bookings, and then the 2Q guide was solid on a constant currency basis, but lower on a reported basis as Uber's facing higher FX headwinds than we thought, particularly on the mobility side. Overall, I think the trends remain strong for Uber, right? 15% user growth. They had 6% trip frequency growth. That drove overall trip growth up 21% year over year. And then on the mobility side, the user growth was 17%. So it was above total company user growth. And they expect that to continue into 2Q and the rest of the year. But again, yeah. So I think just the lower mobility in 1Q and the guide was a touch light. On Lyft, you know, they had a really good quarter, right? They like you mentioned, they beat on gross bookings. Revenue was better. EBITDA also better. 2Q guide on gross bookings and EBITDA were above us. So we raised numbers, raised our price target. And they also have an event coming up. They had their first analyst day in New York City on June 6th. So that was also something that I think people will, you know, probably be somewhat positive kind of going into that, you know, as they're going to lay out, we think they're going to lay out like intermediate term targets.
John, I want to talk to you first just about Uber and more specifically the stock reaction that we're seeing. We've got shares down nearly 8%. Given what you had just laid out there a moment ago, is then this selling that we're seeing today a bit overdone?
I think it will ultimately be overdone. But I kind of understand it. You know, it's been a great stock over the last year. So expectations are, fairly high. And so with a little bit of a miss at 1Q, and as I mentioned, the 2Q guide on a reported basis, a little bit softer, you get this kind of reaction. But like I said, I mean, the core just underpinning fundamentals of the business remain strong. And so I do believe it's a bit of an overreaction.
Well, John, I know that both Lyft and Uber were asked about the potential risk to ride-sharing companies that autonomous vehicles pose, particularly given some competition from Tesla, of course. Both CEOs sounded pretty optimistic, though, so let's listen in.
I get excited about autonomous cars because I think, great, it's going to be another way for people to get around. You can sort of think of it as another car that we could, run into our network.
If you're an AV fleet owner or you are an individual owner of a car, whether that's a Tesla or another kind of car, you're just going to make more money and make a higher kind of return on your investment if you plug in your AVs into the Uber ecosystem and into Uber demand. So, we think we bring a lot to the table. We're looking to partner with the AV industry.
So, John, is it that easy that this can just be a partnership?
Yeah, they both kind of mentioned the partner approach. And like, if you think about it for Uber, right, they have the huge customer base. They have the matching and routing technology for both companies. Big customer bases, matching and routing, the payment systems, regulatory expertise. And that can drive higher utilization for AV partners over time. And I think Dara mentioned, also, he thought AV could expand mobility marketplace with lower pricing, which would spur higher adoption. And Uber in particular has the partnership with Waymo in Phoenix. And they are expanding AV partnerships on the Eat side as well. I think just the reality, in my view, as it relates to AV, is that the headline risk probably won't match the time it's going to take to fully scale the technology. And as it scales, Uber will be the most scaled partner globally on mobility for potential AV partners, and then a leading one, potential partner in delivery. And Lyft will certainly be able to partner in the US and Canada. Those are the two markets that Lyft operates in.
John, can you give us a better idea of what exactly that timeline looks like?
Well, yeah, I mean, your guess is probably as good as mine. I mean, the companies haven't really said. I mean, I think if you listen to Dara today, he said it's going to take time, and even Lyft last night, it's going to take many, many years to be fully scaled. I mean, just for example, I think Waymo's operational in 3 markets with Austin coming. That's 3 markets in the U.S. And so it's going to take many, many years. And I think that's kind of how they were talking about it. And that's why I said, we're going to see these headlines, but actually when it is fully scaled, it's going to be probably many, many years.
All right. TD Cowen's and John Blackledge, thanks so much for joining us here this morning. Well, it's early in the trading day, but a key theme is it's the individual names to watch, not so much the broader market, and it's growth stocks getting hit today. Earnings from Uber, Affirm, Shopify, and Upstart all declining here on the heels of their quarterly results. And Maddie, we're bringing this up on the heels of some commentary that we got earlier this morning from Morgan Stanley's Andrew Sheets. And he was making the case that this isn't really this macro market or macro-driven market that everyone has been talking about. It's more micro, and he pointed to earnings. So today, at least, when you take a look at some of the pressure that we're seeing in these growth names, it really highlights some of that rotation that we've been seeing within the market and where we are seeing maybe pockets of strength outside of the Mag 7. And then ultimately the question is whether or not earnings are going to hold up to then further support the market's gains.
It's a great point, and it's similar to what we've been seeing, particularly if you take a look at some of the ETFs out there showing some signs that we are seeing a little bit of broadening again beyond some of the growthier names that investors tend to look towards. I was looking at the Vanguard Value ETF. It's one of the top 10 ETFs getting inflows this week, which could be an indication that investors are starting to see some broadening. And looking back on our notes too, we know that BlackRock in Q2 said that their outlook indicates that risk appetite could broaden beyond tech. And if you look at those ETF inflows, you are seeing evidence of that.
Yeah, Manny, that's a great point, because even if you take a look at the sector action today and where we are seeing that leadership, that also points to that point that we are trying to make here, are making here, just in terms of that rotation, right? Because when you take a look at the more defensive names that are leading today's trading action, you've got utilities among the biggest gainers today. So again, that's a very different picture than what we had been seeing, especially when you take into account the gains that were mostly driven by the Mag 7 last year. So again, a bit of a rotation. The question is whether or not that rotation is going to stick. Let's do a final check of the markets here. We're still looking at a bit of a mixed picture. You've got the Dow and the S&P holding on to gains just barely for the S&P. The Nasdaq, though, still in negative territory.
And coming up, our new show, Wealth, dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you here for the next hour, and we'll talk about tipping etiquette, so stay tuned for that and more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, housing hurdles. We talk to an expert about when it'll get easier for people to buy homes. Yeah, so listen up for that. Plus, prescription drug prices. We dig into the steep prices of medication for millions of Americans. That part of our Health is Wealth Week. Plus, tipping customs. We asked an expert here to help us define some of the social morals around giving extra cash for services. All that and much more coming up during today's show. Let's kick off the day with housing, though. It's a tough time for home buyers who are contending with elevated mortgage rates and low inventory. And now, a new survey from Fannie Mae reveals 80% of Americans think it's a bad time to buy a house. Here with more is Yahoo Finance's Danny Romero. Danny, take us into this.
Brad, high home prices, rising mortgage rates aren't going anywhere. Data from the National Association of Realtors shows that more than 90% of the metros across the U.S. had price gains in the first quarter of this year. The median sales price for a previously owned home grew 5% over the last year from a year ago to $389,000 for a single family home. And the reason? The low supply is just not keeping up with consumer demand. Some of the regions that did see some of the strongest price gains, one of them being the South, home prices appreciated about 3% on a yearly basis. In the Northeast, 11%. In the Midwest, 7.3%, and in the West, 7.3%. So in the West region really is an interesting equation here, because last year we saw price declines in the West, and we're really seeing a turnaround story happen there. But another key point from this data is really that the monthly mortgage payment for a previously owned home with a 20% down increased 9% from a year ago, and it's about $2,000, Brad.
So Danny, home buyers, they don't seem like they have a lot of choices right now. So how desperate is the situation here?
Brad, buyers are saying no-go to those fixer-uppers. They don't really want to be Chip and Joanna right now, even though that new listings have increased somewhat. The quality of those properties have not. And data from John Burns Research and Consulting, they surveyed about 1,400 resale agents, and they found that 99% of those agents said that they have seen those home listings need some form of repair. There was repair and or updates. Meanwhile, 2/3 of those agents also said that they saw homes that needed severe updating of kitchens and bathrooms. So really this data from John Burns really reflects that buyers are not that desperate right now. They want those move-in ready homes, and that's something where the builders have been able to step up the game and capture those customers, Brad.
All right, Danny, thanks for setting up the coverage here for us today, especially as we continue this conversation around housing. Aside from tight inventories, another major hurdle for home buyers is high mortgage rates. The 30-year fixed currently sitting at 7.22%. And with the odds of a rate cut being largely pushed back to September and maybe even beyond, depending upon who you ask, buyers are surely wondering when they might see some relief with mortgages. For more on this, let's turn to Lawrence Yun, National Association of Realtors Chief Economist, good friend of the show here. Lawrence, always a pleasure to speak with you. You know, just as we think about the broader housing environment right now and what you're seeing show up in the data, what is really at play here? Are we going to see this scenario continue to play out until rate cuts come into the picture? And what is your best guess for when we might see that?
Well, thank you for having me on the show. The most interesting situation from my perspective at the moment is that we have very high mortgage rates, 7.2, 7.3% rate. Despite that, multiple offers are still happening. The buyers are in the marketplace. It's simply that there is not enough supply to fully satisfy the market. Now, of course, there are some home buyers who simply cannot get into the market at the current rates, so they are looking for better affordability when the mortgage rate decline. I do believe that later this year, the Federal Reserve will be cutting rates, which will help the 30-year fixed rate mortgage. But let's look at the longer term. Whatever rate cut the Federal Reserve is delaying this year will simply get pushed into next year. So I think from the U.S. economy, we are looking at maybe 6 to 8 rounds of rate cuts all the way through 2025, which means that mortgage rate will surely be lower over this time span. And people buy a home, and we know from past experience, people always refinance when the mortgage rate decline.
Multiple offers still happening, Lawrence, as you mentioned, but at what socioeconomic class is that more outsized from what you're seeing?
The cash transaction has really risen. Maybe, people are saying, I don't need mortgages. Mortgage rates are not important. Part is that homeowners have built sizable housing wealth in recent years, and especially who are moving to more affordable regions, whether it is from, say, inner suburbs of a major city going into the next county where things are a little more affordable, or in some cases, people moving from expensive states, say California to Nevada, and they can buy all cash. So we have seen a notable increase in the all cash transaction. But let's remember, the first generation buyer, first time home buyers, they're not cash buyers unless their family can help them out. So most first generation, first time buyer, they need the mortgages. They're looking for more inventory. Perhaps it will begin to show a little later. Builders are ramping up production. Now, new home construction is not for the first-time buyer, but at least it provides some trade-up opportunity among existing homeowner who will then release their starter homes onto the market.
And when the Fed does begin cutting rates and they perhaps get in not just a single one-off instance of a cut, but perhaps a few cuts come forward, what type of rush to refinancing do you expect to happen?
The refinancing always very sensitive to rate changes. But I think what is key is that we know we are going to have more buyers when the rates decline. That's almost a certainty. The key question is whether we will have adequate supply to meet that demand. And I think that some of the current homeowners who are in so-called golden handcuffs, that is to say that they are loving their previously obtained mortgages, 3%, 4%, they don't want to give that up. But we know that there are life-changing circumstances, having additional child in the family. Maybe there is some new job at different town, or maybe they were looking for a better school district. So all this more life-changing, big decision impact, I think people will begin to list their property, look for their next home. So as a consumer, be on the lookout for more listing as we proceed through the year.
I saw a stat about the number of millennials turning 40 every day here, and it was eye-popping here, Lawrence. And a lot of millennials are having those key life decisions and changes happening right now, which also very much dovetails into the thinking about what the space is that they occupy for home. Do they need to upsize and get ready for more family formation? What more largely are you seeing among that cohort?
The prime home buying age is typically in the early 30s. I mean, that has been pushed back in recent years to about mid-30s or even pushing into the late 30s. So we know that there is a strong desire for that ownership, but perhaps it's been delayed a couple of years because of a higher mortgage rate than what had been previously, lack of inventory condition. But the inventory is clearly turning for more inventory. We are seeing in the data more inventory now compared to 1 year ago. Now, this does not mean that we are in a balanced market. We're simply moving from super tight market to more availability. That's a good trend. And I think this is a very early indicator that the home sales will be pushing higher later in the year. Furthermore, home prices, 90% of the country right now experiencing home price growth.
There have been a few reports that have emerged about another generation, that's Gen Z, about the amount of debt that Gen Z is relying on right now. To what extent are you monitoring that as how it will play into the home ownership scenario for that generation?
The younger generation, trying to understand the importance of financial literacy, get their credit score under check, improve those credit scores, make those rental payments on time, try to save up for down payment, study hard and try to get a job that pays a little higher income. So all that past factors, the traditional way of getting into home, I think is still at play. But of course, there is a larger debt than normal compared to the past generation. So I think that is delaying some of the entry time of the home ownership. But nonetheless, when you look at the data, homeowners, typical wealth, $400,000, typical renters only at $10,000. People know these figures. They want to be on the ownership side, even though it is a delayed entry point for Gen Z to come in, but they understand the importance of home ownership.
Lawrence Yun, who is the National Association of Realtors Chief Economist. Lawrence, it's always a pleasure to speak with you and great to get some of your insights. Appreciate it.
Thank you.
Certainly. A new survey finds 99% of current and expected resale listings are in need of some sort of repair. That's according to John Burns Real Estate Consulting. So if you are trying to sell your home, is it worth it for you to do some work before putting it on the market? Yahoo Finance contributor Ross Mack is here with some tips to get the best return on your DIY or your renovation investment here. All right, so what do the homeowners out there that are undergoing these projects need to keep in mind?
Well, one, I think everyone has to understand, right? More than half of Americans would much rather renovate their home than actually try to buy a new place, right? It makes sense, right? If you're locked in at, call it sub 3% for your mortgage, do you really want to go out there and get over 7% on a mortgage, right? And I think when you're thinking about renovating your home, you need to ask yourself, am I trying to sell it? And if that's the case, how do I get the biggest bang for my buck? Because when you think about it, you're going to be like, oh, maybe I need to redo my kitchen, my bathrooms. Maybe I need to finish that basement. You know, those are the things that for you are going to make you feel better, but it might not actually add to the value, right? When it comes to it, I think it's very important to actually survey the land and maybe go on Zillow and actually look at what some of the other comparable homes in your neighborhood are selling for to actually get a sense of do they have finished bathrooms? Do they have, updated appliances in the kitchen, et cetera? But one of the things that I learned in doing the research of the show is that when it's all said and done, there's a shock value. So what actually would give you the biggest bang for your buck is the exterior of the house, followed by then the interior. And so when we're talking about the exterior, we're talking about that garage door. We're talking about that entry door, maybe stone veneers on the sidings, right? And then you can get to the kitchen. But when it's all said and done, I think it's important to understand from an aesthetic standpoint, that shock value is what's going to give you the first biggest bang for your buck.
A garage door kitchen walkout is on my Pinterest board right now, Ross. So that's something that I'm keeping in mind for when I do own that house. Ross, thanks so much. Appreciate it.
My man, thank you.
Likewise. Coming up, everyone, Amazon is expanding same delivery on medications to over a dozen cities by the end of the year. Same day delivery there. So should you trust and can it save you money? That's next. Let's do a quick check of the market, sponsored by Tasty Trade. We're taking a look at the major averages in the U.S. mixed right now. The Dow Jones Industrial Average holding on to gains by about 0.1%, but that's the only bright spot, at least among the major averages. The S&P 500 and the Nasdaq are both in negative territory right now. The S&P 500 down 0.1% and the Nasdaq Composite lower by about 0.25%. Well, while shopping online dominates retail, about 90% of consumers, they still purchase their medications in person at pharmacies. Since 2020, though, Amazon has been trying to gain a foothold in this market, even announcing this year it expects same-day delivery services for your meds to be available in up to a dozen U.S. cities. But for the consumer, a major question is how much this will actually affect the overall price of prescription medications. For more, we bring in Dr. Vin Gupta, who is Amazon Pharmacy's Chief Medical Officer, as well as our own Anjali Khemlani. Dr. Gupta, first and foremost here, a lot of people are just wondering what the delta in the prices that they're paying will be when they're thinking about a same-day delivery type of service versus going in person to some of the pharmacy benefits managers and picking it up the old-fashioned way and the way that many of us have been accustomed to for decades at this point.
Well, Brad, first of all, thank you for having me. And Anjali, great to see you again. This is a service that we're launching in select cities across the country. We'll have 12 by the end of the year. We're really excited about it because we know dense cities like New York City and Los Angeles, the two new cities where we have this capability. If you get that prescription in, if your provider can get that prescription in before, say, 5 o'clock, we're able to get that to your door before the end of the evening, and that matters for acute conditions. And this is something that we're going to be growing again across the country, but that time to treatment is critical, Brad. We've talked about this so much during the pandemic. Early triaging, early diagnosis paired with early treatment, we can be at the door. And people are used to Amazon being at the doorstep with their retail needs. Now we're doing it for healthcare, and we're building that trust.
What about the cost of it? To Brad's point, are patients expected to pay any different? Is insurance covering all of this? And are we looking at, sort of a status quo in that realm, or is it more expensive even though it's more convenient for patients to use Amazon?
No, where we offer it, it's included in the checkout experience. So no additional charge for that same day delivery experience. And that's exactly what people expect from Amazon. If this is something where you're in Staten Island, in Manhattan, in parts of Brooklyn, Queens, this is something that will be offered to you in the checkout experience, and something that, again, if you're within that serviceable zip code, we'll offer it no additional charge.
Then tell me, when you're talking about the in-person pickup, I know that just like Amazon's past when bookstores were the target, we're now looking at pharmacies and the in-person pickup part of that equation for pharmacies. And we look at what the push is to mail order and online ordering. That hasn't necessarily picked up to the point of that stat that we shared. But at the same time, Amazon is opening some of those in-person locations. What does that tell you about the market right now and sort of the trust that people have in digital versions of healthcare?
Well, I'm a pulmonologist, Anjali, as you know, and home delivery of medications to me is an area of incredible growth because it means something meaningful, it's useful, significant to clinical outcomes. We know that 30% of people don't pick up their refills on time, or if ever, because it's an inconvenient experience, especially if you're acutely not feeling well. So home delivery, us being the modern pharmacy, meeting the needs of the modern age, we're doing something. We exist for a reason because the existing legacy pharmacy experience isn't meeting those needs. And so, yes, 10%, to your exact point, let's acknowledge the fact, 10% of prescriptions are through home delivery. 90% are still through that legacy system where people spend hours every year in line in aggregate waiting for their medications to get picked up. We are providing an alternative for patients and for their providers across the country. I'm at the bedside. If I know that my patient who's not feeling well with a COPD exacerbation can get their refills on time or their antibiotics on time that same day in a place like New York City, why wouldn't I want to do that? So I think part of this is just building the awareness that there's a better alternative, home delivery, the modern pharmacy for the modern needs of a patient. and that we need to start moving away from the legacy system that isn't meeting those needs.
Is Amazon able to negotiate materially different with drug makers to the extent that your customers, Prime members, subscribers or not, would be able to see the delta in what they're paying, or, whether they were going to be purchasing that via pickup through one of the PBM competitors or through Amazon?
Well, Brad, what I'll say is we have created a storefront experience that might be evocative if you've used Amazon.com for your retail needs. Amazon Pharmacy, very different portal experience, sign-on experience. We keep health data separate and private from, let's say, if you have a retail profile. But there's some similarities in terms of pricing transparency based on how you want to pay. We offer multiple different ways to pay, either through estimated insurance pricing if you haven't input your insurance, or through a direct estimate of your copay if your insurance is on file. We have a discount savings program, the Prime Prescription Savings Discount Program, that is essentially reflecting a cost plus model for a variety of drugs. And then critically, and I think this is the real differentiation here, Brad, for branded medications like insulin products, if there's a manufactured coupon for one of those insulin products that we have for this on our website, that we're as part of our coupons program, we will automatically apply that to the end cost. That is not something, I should emphasize this, that is not something that is commonplace across the industry. People have to go hunting for it. 85% of the time that coupon goes unapplied. So if there is a way to save money on medications, whether it's a branded medication or a generic medication, you will find that at Amazon Pharmacy through a very easily navigable website and storefront experience.
Vin, finally, we're looking at the entire industry and where it's going. PBMs in particular, have a lot of say in this industry, and there has been a breakup. Some employers are looking at, and California Blue Shield, for example, partnering with you to provide certain prescriptions in order to reduce costs. And I think that's the point that patients are looking for: is where can costs come down for them? So how do these partnerships, including the one with Lilly Direct that was recently announced, and likely other pharma companies that are coming in line for direct to consumer, you have that avenue with the Amazon network. How does that translate into a better experience, but also lower costs for patients?
Well, Anjali, you said it right there. The pilot that we announced that's going to go live in 2025 with Blue Cross or Blue Shield of California, and some of our some other peer stakeholder groups like Cost Plus and a few other stakeholders. We're really excited about the potential of that, because exactly to your point, that the journey of the prescription medication is different in that model, where it's sourced directly from the manufacturer, where we're able to directly deliver it direct to the patient. And so if there is going to be a markup in price that historically sometimes might be happening in different ways to acquire a prescription, this is potentially offering a different alternative where you may not see that level of markup, and the patient's going to ultimately benefit with a lower cost. So if there's an ability to innovate with traditional stakeholders, and by the way, that pilot includes many traditional stakeholders, we will do that. We've shown a willingness to do that. Lilly Direct to me is very interesting, because that's Lilly saying they can choose any pharmacy to partner with. We're one of two to do home delivery. And there's a reason why they did that, because they recognize, by the way, this is not only just limited to GLPs and Zepbound, it's also insulin medications and migraine medications. But what's important to them? They're really concerned about proper prescribing of these medications, making sure the patients that need these medications, Anjali and Brad, get these medications. And so what do we have beyond a home delivery? Rapid delivery in places like Seattle and California and New York City, or Los Angeles rather. We have clinical excellence. We have a team of clinical pharmacists that I work with closely that can answer questions on side effects that are available 24/7, 365. So when you couple that with the ability to have home delivery, we're truly building the modern pharmacy that the future needs, that the patients need right now, but certainly the pharmacy of the future. That's why Lilly is partnering with us. It's bringing responsible prescribing of these critically needed medications to patients that need them the most.
Dr. Vin Gupta, who is the Amazon Pharmacy Chief Medical Officer, and our own Anjali Khemlani. Thanks so much for the time and the conversation.
Thank you.
Coming up, everyone, the energy sector is up over 11% this year. So is it time to consider an energy ETF? We ask a portfolio manager. That's right after the break. President Biden unveiling an over $3 billion investment in a Microsoft data center today. But data centers, guess what? They require a lot of energy. They consume about 1,000 kilowatt hours per square meter. That's about 10 times the power consumption of a typical American home, according to CNC Tech Group. And as new data centers continue to open up to support generative AI, power and energy might be a good ETF play for investors to consider, especially thinking about the sector and how it's up over 11% year to date as part of the ETF report brought to you by Invesco QQQ. Joining me now, we've got Eli Horton, who is the TCW Senior Portfolio Manager here. Okay, we just laid out the chart, and looking at energy and the performance over this year so far, I mean, is this an area where investors could potentially see some continued upside momentum here?
Yeah, well, thanks for having me. It's good to be here. I think we are really starting to see the beginning of what we consider a mega theme or a transformative investment opportunity in the transformation of our energy system. If you think about it, we are in the very early innings of migrating from using all fossil fuels to 100% renewable power generation, and we are only about 15% of the way there. Right. There's been a lot of lofty targets that will make it by 2050 to a net zero state. We won't. This is a very complex challenge. The world's investing $5 to $6 trillion per year to solve this problem, and within this broad system, and it's very broad, it's not just energy companies, right. There's a there's a litany of really interesting opportunities.
What is the real timeline then that investors should be keeping in mind as kind of the core thesis around the energy landscape right now?
So like where we focus is very long term. So certainly multi-year in nature. Last year, 2023, was a very informative year for this thesis. So there was a large developer of offshore wind farms that walked away from 2 wind farms off the coast of New Jersey, $3 billion that they sunk into the ground, and these wind farms were deemed uneconomic, and they walked away from it. Wow. Hertz sold about 1/3 of its EV fleet. Why? It was too expensive to maintain them. They couldn't charge enough to the consumer because of some range perceptions. And so those are 2 examples of how difficult this transformation is. Where does it create the opportunity? We think it's more in the brown businesses, the legacy companies,
What
rather
are the
than
brown
green
businesses?
So think like ExxonMobil, for example, not just your classic green company. We'll invest in both, but we are seeing businesses that have sort of been left behind by the market as they focus on growth that are really interesting and are very attractive from a valuation perspective.
You think about some of the infrastructure and even the investments that we were talking about a moment ago with the data center that President Biden visited with Microsoft's President Brad Smith. And we think about where that also leads into this broader kind of correlation between generative AI and energy. I mean, how have you been monitoring that?
So the power and electrical grid is fascinating, and it is a problem that is going to persist for years. And let me give you some context, because AI has just kind of lit a match on the dry kindling here. So the past 2 decades, power demand in the US has been dead flat. Over the next 25 years, power consumption is going to double.
What's the risk to that, though?
Well, here's the risk. Our grid is already a mess. Think about all the brownouts that we have. I live in California, we have brownouts all the time. Texas declared a state of emergency in its grid last fall. So the grid already cannot handle the current demand. Now we are going to double demand. It's from electrifying vehicles, buildings, it's from bringing manufacturing back here, reshoring, it's from AI. So demand's going to grow. How are we going to solve that? We're adding wind and solar to the grid. That's great. Those are intermittent sources. Wind has to blow, sun has to shine. So it's less efficient. So to meet a doubling of demand, we need to triple grid investment. That's a lot of capital dollars, and the businesses that are providing solutions there will absolutely benefit.
And the ETFs that you're tracking right now that seem most apt to keep pace with this demand right now?
Right, so there's a couple strategies that are very relevant here. The first is called Transform Systems, ticker NETZ, NETS. That focuses on this energy transformation. And then the second is Transform Supply Chain, ticker SUP, SUPP, which really focuses on bringing manufacturing and reshoring back to the U.S.
Eli Horton, TCW Senior Portfolio Manager. Eli, great to see you here in studio. Thanks so much. We've got much more on wealth after the break, everyone. You're watching Yahoo Finance.
So what's the next move in markets with Fed rate hikes or cuts in focus? Let's dive in. Nuveen CIO Sarah Malik. Sarah, good to see you in person for a change.
Yeah, it's great. Finally off the Zoom video.
Yeah, right. I was telling Akiko, I love what you wrote recently about May potentially being weeds for markets. Explain that to us, because I'm like, wow, I got to ask Sarah about that.
Well, we already saw the rain showers in April, so the question is, will weeds be coming up next? Markets are really fixated on what's the next move by the Fed. When will we get rate cuts, and what's going to be the magnitude of them? And really, there's two things for bulls and the bears. For the bulls, payrolls missed for last month, and also manufacturing data has been weak, with Q1 GDP missing estimates. But the bears can still point to inflation, which is well above the Fed's target, and consumer spending. Until that inflation number hits the 2% Fed target and stays there sustainably, the Fed's not going to be cutting rates.
Is it fair to say you're cautious on stocks here?
I think at S&P near 5,200, I am cautious. I see it more in a trading range. I don't see any imminent issue to take the markets down. But my concern is that without these rate cuts coming in the near future, what does that mean for the economy in terms of its ability to hold up? And we are seeing those cracks already somewhat in the employment market and with manufacturing.
On that point, we heard from Minneapolis Fed President Neel Kashkari here at the conference on the ground, raising a number of issues. Number one, how much of where inflation is right now is in the control of the Fed, but also whether in fact we're landing softly at 3%. He said that keeps me up at night. You've been in the camp that you don't think inflation is going to reach that 2% target this year. Why?
I think what the Fed has been battling is inflation, and they're trying to raise interest rates in sort of to tamp inflation. But what we've seen is, a couple of years of rate hikes, and inflation is still, if anything, starting to re-accelerate at the beginning of this year. So and there's another thing that's out of the Fed's control that does drive markets, and that's earnings. Earnings have been very strong, and they've been led by technology companies. We have the large digital shift to artificial intelligence. That's been driving earnings higher, and that could continue to, and that's really out of the Fed's control too. So it is a challenge for them right now, trying to slow the economy enough so that they can clamp down on inflation.
One of the things that we heard from Fed Chair Jerome Powell last week, Neel Kashkari seemed to reiterate here at the Milken conference, is the labor market may be sort of that impetus that drives a potential rate cut. In other words, even if inflation remains at 3% or above, if they start to see more deterioration in the labor market, that would be a reason to cut. How are you thinking about those two mandates right now?
Well, first of all, April's employment consensus was a high hurdle. It was one of the highest consensus numbers we've seen since 2022. So it was going to be a hard one to beat like we've seen in prior months. So I wasn't surprised to see payrolls miss this month, but they're still reasonably strong. Markets rallied last week on the Fed's comment because they were actually relieved that rate hikes were taken off the table. I'm not convinced that we're not going to see another rate hike. If inflation re-accelerates and the economy remains strong, I think you could be bringing a hike back on the table. It's not our base case, but I think it's still an issue out there.
Let me just check some of these off. Job market slow down a little bit. Economic slowdown is happening based on GDP. Election season, inflation is still high. Are investors still being very complacent?
Well, economy slowing moderately, so not in a recession. Election years do tend to bring higher volatility, but markets tend to go up in election years, so that's kind of a neutral, even somewhat on our side. So those are important, and let's go back to earnings, which are the real key driver of markets. Earnings have been strong. 80% of companies in first quarter of this year have beaten earnings consensus. That's a positive for the markets. It's led by technology stocks, where I agree we need to be a little more selective. But that earnings, as long as they continue, I think markets can stay resilient, even though they are a little bit expensive.
As you look ahead to the second half of the year, the election on the calendar, obviously, where does political risk factor into your overall assessment when you're looking at your
I'd say
portfolio?
short-term volatility, long-term less volatility, because we'll go back to the economy and earnings once the election happens. But leading up to it, more volatility in the markets. And we do have new things to consider this year. Even though the candidates are known, which would be sort of a positive for the markets because they like transparency and clarity, think about artificial intelligence, potential misinformation, international issues, how we're dealing with all of these geopolitical issues. Those are going to be important to the voters, and that could also impact market movements and election volatility.
Mark Lazary, the founder of Avenue Capital, told me, because everybody is so over-allocated or over-invested in the magnificent seven names, NVIDIA, Apple, Amazon, you name it, we might be now looking at a year of underperformance because everybody is invested in these names. Do you agree with that?
I think it's the year of being selective, and you saw that last week with Meta, which actually put up a good quarter with 27% revenue growth, but the whisper numbers were for 30% revenue growth. Stock goes down because it's overowned. Now you look at Apple, where if you look at the fundamentals of the quarter, it's more about the next iPhone cycle, seasonality trade, but stock was underowned, so Apple goes up. So I think that crowding in these tech stocks is important for these stocks. But then we have these more resilient ones like Amazon, Microsoft with its multi-year head start in artificial intelligence. These should continue to be like the little engines or the big engines that could.
You mentioned it's time to potentially look for defensive assets. Isn't Apple or an Amazon a defensive asset?
Apple is pretty defensive because it's under-owned. Amazon, I think, just has a resilience from investing in their logistics during the pandemic. When we say defensive assets, we're also talking about areas like infrastructure, multi-year positive trade for us, because not only are we nearshoring, onshoring our businesses, the shift to renewable energy, both of those require more investment in the U.S., and the components of infrastructure, like utilities and waste management, tend to be less economically sensitive.
You mentioned the huge swings we saw on the back of some of the Mag 7 names. It's interesting to me that there seems to be, on the one hand, some concern about the scale of investments that are needed to ramp up their AI offerings. And yet, you look across, I mean, you know, Meta had a big number, obviously, in investments. That seemed to really affect their stock, investors' concern, but that wasn't the case with a name like Microsoft or even an Amazon.
Yeah, I mean, I would say that, you know, the long-term head start, though, that companies like Microsoft and NVIDIA have are important. I mean, go back to the late 90s where we were shifting to more use of the internet. There were so many companies out there. I mean, we all remember iPads, companies you could buy which really weren't resilient businesses. Companies like Microsoft and NVIDIA, I think, are long-term plays. They have gotten such a head start in terms of investing in AI. I think those are going to be the long-term winners, barring a little bit of, you know, up and down because of their valuations and where people are positioning in the stocks.
You talk to a lot of investors. Let's focus on the average investor. What's the number one mistake you still see them making?
Cash on the sidelines. Studies have shown that when you market time, you lose money relative to if you just stayed invested. This started, last year. Everyone expected a recession to come. They are holding their cash, and 5% returns, nothing wrong with 5% returns. But when the market is up multiples of that, and even fixed income markets have yields that are higher than that today, you're losing relative money. So I really recommend stay invested, leg into the markets, average in. That, I think, is the biggest mistake investors make. And then, of course, they eventually get FOMO, fear of missing out, when they come piling back into the market when the market's already up.
I feel like that's kind of right where we are right now.
Right? And so basically, you just told me I'm making a mistake. I thought I was doing pretty good with my 5% CD, but maybe I'm not.
It's funny, Brian. I sort of checked myself when you said that as well. I think she's talking to us.
I say 5% is good in 2014.
Nice. Wow, it's a hot take. All right, we're going to leave it there. We meet CIO Sarah Mal. Good to see you in person. We appreciate it.
Yeah, great. Thanks for having me.
it's been a bit like too much now lately. I've seen it go from like 12 to 15% to where you go somewhere and it's automatically 25%.
The pricing of food has gone up, so tipping has gone up.
It's a double-edged sword, but at the same point, we are getting the service. Here in the States, a lot of the servers are making minimum wage. They depend on that tip. It's also the server and the establishment to give that service as well. So if you're not giving the proper service to your clients, do you really deserve that 20%?
Usually in Italy we don't use tipping because we assume that waitress and so on are paid by the owner of the enterprise, and so it's very different from here where tipping is requested to customer.
Now, today it's actually, you're kind of more forced into it. The moment that you pull your card out, they're like, it's on the machine. Do you want a tip?
When they flip the laptop around at you.
When they flip the little thing around.
You feel like you're watched, like somebody's, bearing down on you.
It's almost giving you that guilt feeling that if I do or don't, and I don't feel that that's the right thing to do in a business atmosphere.
It's really about the experience you have with the service person. Having waitressed and made a living that way through college and graduate school, but I don't like to have to do it and feel like I have to do it.
If you wait on somebody or do a service, absolutely you're entitled to a tip. When it's like a self-service culture, I don't know that the tip is warranted.
Normally tipping should be a reward towards a service or something that's exceptional, and it's almost like you're forced to do something that you may have not done because the service wasn't necessarily exceptional.
The advice I would give is if you don't have the tip, don't go out. And that's not really for coffee. I guess it's more towards restaurants, etc.
We've all been there. We're just picking up a sweet treat, perhaps, and then the employee flips over that iPad and you're met with the dreaded tip screen. Then comes the guilt and the question, do I have to tip? Some businesses often depend on the consumer to supplement their tipped employees' wages, and there are a lot of them. Nearly 4.3 million tipped employees in the U.S., according to National Employment Law Project. As part of Yahoo Finance's Small Business Big Opportunities Week, we're breaking down the psychology around tipping, and Michael Lin, Cornell University professor of services marketing, is here to tell us more. So perhaps we begin with that very question. What are the do's and don'ts? What's the perhaps rule of thumb here that we should be deploying when we're kind of going tap of the button when that iPad is turned around?
I don't really like to tell people what they should and shouldn't do. I don't think there's a god of tipping, and I'm certainly not it. But I can tell you what people do, right? When people flip that screen, it's not just the anecdotes that you began this section with. Research tells us that people do feel pressure. They will leave a tip, but they're not happy about it. Okay? But what perhaps you don't know, or your viewers don't know, is that in these kind of counter service settings, the majority of people are still not leaving tips. Only for baristas, for restaurant carryout, and other counter service situations, it's typically 30 to 40% of customers who are leaving a tip, which means that most people are not. And I think you should take feel some freedom to join the majority if you don't want to tip.
Interesting. Okay, so how important is tipping, and how does it help small businesses as well?
I'm not sure that it helps small businesses as much as people think, because while it does save labor costs, those savings typically are passed on to consumers in the form of lower prices. So that the real beneficiary, what tipping does is it gets price insensitive customers, people who are willing to pay more than they have to. They're effectively subsidizing the patronage of more price-sensitive customers who aren't willing to pay more than they have to. Because of tipping, those price-sensitive customers are getting lower menu prices.
And so all of these things considered, we were just taking a look at the screen here, and we had a graphic that we were showing our viewers talking about where people most often tip and who they don't tip. Yeah. What have you seen in some of those behaviors?
Yeah, look, we most often tip waiters and waitresses. We also tend to tip delivery people, bartenders, taxi cab drivers, people that we don't tip, no one tips effectively, people like doctors, tax accountants, lawyers. And then there's this middle group where a substantial number of people tip, but not a majority. And that's things like hotel maids, Uber drivers, and counter service. Even baristas, the majority of people aren't leaving a tip.
Should small business and even larger businesses as well that are in the service industry, should they be accounting for what an employee would make in tips and factor that into the wage that they're offering? And when do you believe we'll see that be a reality?
That is a reality. You're allowed to pay a sub-minimum wage to tipped employees, provided that they make up the difference in tips.
All right, Michael Lin, who is the Cornell University Professor of Services Marketing. Michael, thanks so much for taking the time here with us today.
It was a pleasure. Thank you for inviting me.
Absolutely. Well, you've seen it in restaurants when you're paying your bill. Toast. We're not talking about the bread. We're talking about the cloud-based restaurant software company. Toast reported earnings that beat Wall Street expectations. And guess what? It's top trending ticker on Yahoo Finance. For more on what the results say about the consumer, we have Yahoo Finance's Madison Mills. Hey, Maddie.
Did you like that toast intro?
I love
that just
it.
for you. We did that just for you.
I mean, you know I order a croissant, bacon, egg, and cheese every day, but we'll go with toast for right now.
Well, it's interesting because I know the last guest was talking about how tipping maybe is used to kind of save money for the business and then they can pass that on to consumers. But when you look at these Toast earnings, I get an indication of the complete opposite story. I see a picture of restaurants that are utilizing something like tipping to be able to keep profits strong. There is evidence of that in this Toast earnings print. We saw 142% EBITDA beat. That is telling me that restaurants are doing really well. But just to back it up for anyone who's not familiar, if you have not seen Toast before, this is the POS system that restaurants are using for things like your Apple Pay, for example. If you have a waiter come over to your table with a little credit card looking machine, you can look for that Toast logo. My boyfriend and I are obsessed with this because we're nerds, so we're constantly looking to see what POS our restaurants are using. A lot of the times it's Toast. You can also use this product to do things like change up the menus. They have a kitchen option they can use. You can see on your screen what I'm talking about here. And also it can be used as a reservation tool for restaurants as well. So what's interesting in this earnings print, again, huge growth for the company. We saw several folks coming out across the street raising their price targets for Toast following these earnings. And again, what I think is interesting for the consumer to look at is the profit gain that indicates to me that restaurants are doing well, which could be an indication that the consumer, they're still eating out.
I mean, I like it because I think I collect points whenever I eat at a place that does have Toast, or one of the, it's either Toast or one of the competitors here. I mean, at the end of the day, the pandemic has completely reshaped the dining experiences, and for the point of sale systems that we have just become accustomed to at this point, Toast has cemented themselves. It was a question of whether or not they would be able to retain the same type of merchant or client base that they had in the immediate kind of receding of the height of the crest of the pandemic.
It's a great point, Brad, because also they have one of the products that they offer is the one where you can kind of do the ordering yourself, and a lot of restaurants were using that and picking up on that product during the pandemic. So they did have some struggles during COVID. They instituted a restructuring. They recently did another one that is weighing on their profits a little bit still, but I would love for every restaurant to let me just order. I don't like talking to people.
What?
Wow. I get nervous when I have to order with a person.
I mean, one of my first jobs was a waiter, so
I get nervous. It's not the waiter, it's me.
I also wasn't good at it, so there's that. Let's do a final check of the markets here, everyone. Taking a look at the Dow, the S&P 500, and the Nasdaq. The Dow is holding on to gains. That's up by about 0.2%. S&P 500 and Nasdaq down right now. That's it for Wealth. I'm Brad Smith. Thanks so much for watching. We'll see you tomorrow, and stay tuned for Market Domination with Julie Hyman, Josh Lipton. That's coming up 3 p.m. Eastern Time. You don't want to miss it.